everyone. I am Ankit Kanodia from SmartSync Services, a SEBI registered investment advisory firm. Welcome to yet another episode of Mission Smile guest webinars, a new Mission Smile initiative. If anyone who has joined recently, as in, I'm sorry that the video is not on today because of some connection issue. So this is a new initiative, new Mission Smile initiative where we invite our peers from the industry every month and learn from their unique investing styles. Before we begin, I would request everyone to keep yourself on mute. I'm just muting everyone, okay? And switch off the video so that we can have a seamless discussion and soak in all the knowledge. You may type in your question on the chat box. We'll make it an interactive session from time to time. It's not like that Manan will be speaking for 2 hours and then only after the end of the 2 hours you'll be able to ask questions. We'll take breaks in between and you can all ask questions. Okay. And now let's welcome Manan. First of all, thank you so much, Manan, for agreeing to do this. I'll just give a brief intro of you because as you are not on social media, many people don't know what you have done and achieved in life so far. So Manan is a full-time investor managing proprietary funds. He has been investing in the Indian stock market for over a decade now. So he started his journey around 2012. His area of interest is small and mid-cap stocks, which I'm sure many of our audience would be interested in. So he's basically looking at stocks which are under researched, right? Manan applies value investing principles on the following themes to generate investing ideas. Which are those themes? He looks at compounders, he looks at special situation, and he also looks at cyclical bets. His investment horizon is generally 3 to 5 years, right? While I'm speaking, I've just started sharing my screen. I hope it is visible to all of you, right? You can just show a thumbs up so that I'll be knowing that you have been able to see the screen. Great. So Manan has worked also with Viraj Mehta of Equirus Wealth PMS as an analyst. He quit in 2021 to pursue full-time investing. And Manan has also worked with JP Morgan, ICICI Bank, Chola, MS General Insurance, and a few boutique investment funds. He did his MBA from MDI Gurgaon and studied value. Despite maintaining a low profile, some veteran value investors like Kuntal Shah, Ankur Jain, and Arpit Ranka know Manan personally because of his clarity of thoughts and investing finesse. So I stop here, Manan, and I would like to now ask you to maybe probably give a short intro or maybe an opening remark, and then we can begin your presentation. Just before that, I'll also like to mention that Manan will try to present on a company called HOEC. Depending upon the time we have, we will also like to, I personally want him to share a little bit more about his investing psychology and philosophy and process, because that is where I think most of us will gain a lot from it. So depending upon the interest of everyone present and the time we have, we will try to cover that as well. Okay, with this, Manan, over to you now. I'm making you the presenter also so that you can now start sharing your screen. Yes, I've done that.
Okay. So you guys can see my screen?
Yes, Manan, I can see.
Oh, great.
Please go ahead.
So thank you for this wonderful opportunity, Ankit, and kudos to the great job you are doing about educating a lot of people. So it's a very important thing in sort of markets which which can take people for a ride. And I have been one of the persons who have experienced that. So it's very interesting that you do such nice work and help a lot of investors. So thanks for that, and thank you for this opportunity. So about a bit about myself, I have been in markets for more than a decade, and uh, have been sort of learning a lot from. So starting with Sanjay Bakshi sir, who provided sort of a light of which direction you should go in. I have been on the way learning a lot from fellow investors, a lot of mentors I have had, and all the credit goes to them. Obviously, books and all they help a lot, and personal interactions with a lot of these investors are like sort of a frosting on the cake. So it has been a wonderful journey, and markets have been very kind and rewarding for me. That enabled me to be on my own since last 2 years, and I hope to continue this journey for next few decades. Uh, we can, I think we can start this presentation, and through this presentation, any of you, if you want to ask any questions, please feel free to raise your hand and ask questions whenever you have a doubt. You don't wait for any breaks or towards the end. And depending on the interest, because this is a sort of a niche sector, uh, depending on the interest, we can go as much deeper as we want till my understanding permits. So, any of you have any questions on if you want to go deeper on some particular aspect, we can do that. Uh, with that, I think I'll start my presentation. And forgive me, this is my first time of presenting on any company to a group of people. So forgive me if I make any mistakes or uh, thank you. And
And
just for
sorry for interrupting here. So don't worry about that. You're doing a great job. And just to mention to everyone, I forgot to run the disclaimer. So I just want to quickly say that me, myself, and my company, SmartSync Services, we do not have any position in the stock. And idea of this presentation is not to give any buy sell recommendation. Since we are a SEBI registered investment advisory firm, we thought that we should make this disclaimer. And it's not that we have some interest in the stocks. That's why we are having this presentation. We are having this presentation because we like the way Manan does deep research, and we are very sure that you will gain a lot out of it. Yeah, thank you, Manan. You can go ahead now.
so just for the record, this is Ankit's disclaimer. Uh, And so yeah, we'll go ahead with the company. This is my short disclaimer. So I am not any SEBI registered RA or RIA, and this is obviously not an investment recommendation. And I am invested in this stock, so that is another disclosure. And I might be biased because of that. I'm not an expert in investing or in this sector. So whatever my views are, it's for educational purposes for you and for me as well. So while making this presentation, I learned a lot about the company, even learned a bit more about the company as well. So with your questions, I might get a few insights as well. So that's my disclaimer. Now, I'll start with how I think about investing in general. So my investment framework starts with this quote of Howard Marks. So there is no asset so good that it can't be overpriced and become a bad investment. And very few assets are so bad that they can't be underpriced and be a good investment. So idea of this is you can't buy uh, asset at any price, even if it's very good. It might not be a good investment, even though it might be a great asset. Similarly, there are assets which are bad or perceived to be bad, but they can be so underpriced that they can become very good investments. So that's the sort of cornerstone of how I think about investing at this point in time. So I tend to invest in a lot of companies which, for whatever reasons, are underpriced uh, or are misperceived by the markets and might even be bad assets. And uh, uh, obviously, this road is filled with potholes, and I might tumble a few times. But if the things work out, they are generally tend to be very rewarding. So in terms of investment framework, these are the aspects that I generally like to touch on whenever I'm working on any company. And this is pretty obvious, but uh, so business quality, management quality, valuations, and risks are pretty general. But over a period of time, I have realized that triggers or catalysts which can unlock the value of any share have become very important in my thought process, because a company can be undervalued for a long time until unless there are triggers which play out and they sort of tend to help unlock the value. We will discuss about what these triggers can be during this presentation. So just wanted to keep that in or put that on the table. Now, as I mentioned, so business quality is important, but it's not that good businesses always make a good investment. So that is how I have been thinking about this thing. And there is a spectrum of business. So business can be very good, and there can be business which are uh, doomed, and they are like on the road to bankruptcy. We see all these types of business in the markets. So there are paint companies, Asian Paints, and all, structurally very good business and great things that they have done for the management as well as the investors over a long period of time. Uh, then there are cyclical companies. HOEC is one of the cyclical companies that we will talk about. Then there are cash guzzlers, like let's say, for example, textile industry. They keep on guzzling cash. Generally, their ROCs on a normalized basis tend to be around their cost of capital. So uh, there are times when they keep on guzzling cash for a long time, and investors might not make money. But there are times when these assets become so cheap that investors can still make money despite these businesses not being as good as structural plays. And then there are sort of bankrupt companies. These can also be very good plays, provided you understand them and uh, you do your work related to that. So recent example for that was, I think, CG Power, which was a bankrupt company, and Tube Investments took it over, and they just turned it around beautifully and made almost a 20 bagger in I think less than 2 years. So there are many ways to make money in the markets. You have to find your sweet spot. I tried to fiddle with everything wherever I understand the situation and the business. So that's the idea. Now, to start with HOEC, HOEC is one of the very few E&P companies, exploration and production companies, or which we call upstream companies in oil and gas sector, and which are private and listed. So you know, ONGCs and Oil India, they produce gas, but they are government owned or government promoted companies. This HOEC company goes back a long way. It was founded in 1983 by the founder of HDFC Bank, H.T. Parekh. And HDFC Bank is still invested in the company, but they are selling their stake now. But they had a good stake of almost 11% in this company throughout the journey. Recently, they have started selling their stake. In between, during the time from late 90s to mid 2010s, the company has changed their promoters or their hands many times. So company went to couple of three MNCs before it came back to Indian hands. So it was Unokal Bharat, Duren Energy, ENI. ENI is still a big name in the industry. So they were the latest promoters of the company before it came to Indian hands in 2015. In the meanwhile, they had one big asset called PY1 in Kaveri Basin, which was commissioned, but they faced some structural problems and it was shut down. So that was a very big roller coaster ride for the investors at that time. I'll come to that. We have a slide on that as well. In 2015, a guy named Mr. Ilango and Mr. Jiva both have a good background in ONGC and Kane. They had decades of experience in oil and gas industry. They took over the management of the company, and in subsequent year, there were a few other investors who came in and joined the board. So essentially, it became a management buyout of sorts. Uh, and then the company has charted the current uh, journey of the company has been with Mr. Ilango and Mr. Jiva. We will talk about them as well. Now, on the way they won, India discovered small field auctions in 2016, and the first auction was when first auction was conducted. HOEC won a block called B80 in Bombay High, which plays a very important role in our thesis uh, uh, for this company. So we will talk about that. And then there is D-Rock, which is a onshore field in Assam, and they are that field is a gas field. So company produces gas from that. It was one of the fields which was commissioned very fast after the new management came in. So that was sort of very good for the company at that time. Uh, and then right now we are in the phase of commissioning of B80, which is an offshore field. We will talk about that. Ankit, you have the ability to unmute whoever wants a question, right? I am not looking at that.
Yes, Manan, I have just typed on the chat box also that if anyone has any
Yeah.
question, he can raise his hand and we can take that up immediately. So I'm watching that. Don't worry about that. You
Okay.
focus on the presentation.
Great. 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 So, okay. So now this is a brief overview. One second. Yeah, this is a brief overview of the company. It has around 11 blocks, of which 10 blocks have discovered resources, but they are right now producing only from three or four blocks. Uh, major blocks are this
Manan,
B80. Yeah,
Chitresh has a question. Shall we take
yeah,
that up
sure,
right now?
sure, definitely.
Yes, Chitresh, I have unmuted you. You can ask the question.
Sorry, my question was on the previous slide, actually. Sorry to disturb you in this one.
No problem.
Yeah,
Yeah,
so
please go
when you
ahead.
told about Mr. Ilango and Mr. Jiva taking over, the current structure also, their shareholding is pretty low in the firm as of now,
Yes,
and we don't see any more personal money being put in, or trying to increase stake, or any other fund house increasing stake in this company.
right.
So what's your take in that? I mean, it's a pretty huge company. Still, we don't see much players.
Yes, so we will come to that. Uh, so Mr. These guys bought in their stake during initial rounds, and they had some ESOPs also, but they have not been buying from the market. From what I understand, these guys, whatever net worth these guys have, they don't come from a very rich background. They were in job with ONGC. Then Mr. Ilango was with Kane India for a long time. He was a director. He was the one who took out first gas in Rajasthan field for Kane India. Uh, but whatever I understand, their entire net worth is linked to this company right now. They might not have huge stakes in the company, but their network is linked to the company for now.
Oh,
Uh,
that's good.
yeah. So that is what my understanding is. We will come to that skin in the game part for the management later on. Yep. Okay. So, uh, so yeah, current big place for this company is this one DROC field. That is the revenue generator, major revenue generator for the company for now. So which is somewhere in Assam in here. Then there is B80, which is scheduled to come online, which is in Bombay High. Bombay High has been a very prolific field for ONGC for many decades now. So ONGC has a few, 3 or 4 fields which are very good. B80 is one of them. Sorry, Bombay High is one of them. And there are few small assets in Gujarat in Cambay Basin. So they produce, but that is not a very material thing, but it still generates cash flows for the company. They had an asset in PY1 which is a big asset, but that field is somewhat has been proven to be somewhat difficult in terms of drilling wells and extracting gas from that. So that has been a challenging part, and we will see how that field affected the company in its journey to start with. So that is largely all these oil, largely HOEC is currently a gas producing company. So uh, all of the fields have all gas as well as oil, but some fields are majorly gas producing. They produce some oil as well along with that. Other fields are oil producing. When B80 comes online, HOEC will have a large portion of their revenues coming from oil as well. So right now we are predominantly a gas company. Now, we last how the current management came into the play. So before this, ENI was holding the share and holding the promoter stake around 47%. So it started coming in news in around 2013, early 2013, that they wanted to sell the stake in the company. They wanted to sell the stake at rupees 135, 140 rupees per share, but it did not happen at that time. Later on, few years down the line, when ENI decided to completely exit Indian markets and focus on their own operations, it's an Italian company, so they wanted to consolidate their position in other markets, and they wanted to exit Indian market. So sort of it was a distressed sale for them. They ended up selling the company at almost one fourth or one fifth of the price they wanted to sell. This happened in 2015 and 2016. So for producing for creating infrastructure for producing gas in PY1, they had spent a lot of money, almost 1500 crores they had spent for a company of this size. Now uh, uh, now they while they had to exit, the parent company had given a uh, loan to this company for creating that infrastructure asset. Now these guys, Mr. Ilango and Mr. Jiva came in. They negotiated deal with ENI in such a way that ENI waived off a loan of almost 1,000 crores given to this company at that time, and the assets were still there, but that loan was waived off because the well was not producing, but the infrastructure, rig, and all the things were still there. Now these guys were able to get these assets sort of for free, and then they wrote off almost 1,500 crores of investments in this well, which created a huge tax shield for them, which still out of which still almost 800 to 1,000 crores of losses are left. So they don't have to pay taxes till they create profits of more than 1,000 crores. So that's a big positive for a company like HOEC, which is trying to create profits. Now let's look at the journey in terms of basic financials for last 10 years. Now if you can see FY10, there were the news like towards the end of FY10 there was news that PY1 will start producing, and around January or February PY1 started producing. Now, later on in FY11, the things went well, but towards end of FY11. Now, just to give you a brief background about PY1, PY1 is from what I understand now, is a very different sort of a gas basin. Like generally what happens is there is a huge basement of sorts within the Earth's crust, and from that there is gas all around, and you can drill a well and pull out the gas. Whenever that pressure in that part of the thing, that part of the basement or basin goes down, you drill a well in some other place and start producing from there. In PY1, it's a fractured basin of sorts, which has a pockets of gases, and those pockets are not connected. So if you happen to drill a well in a wrong place, then it becomes very difficult for you to pull out gas from that. So there might be technologies which currently these guys are exploring, but at that time they did not know, and PY1 stopped producing within 1 year uh, after they commissioned it. So it was expected to be a big find for them, but it turned out to be a dud at that time. That's what happened. If you can see, FY11 revenues were decent, but FY12 it started stuttering, and in FY13 they took the first write-off of around 500 crores. This was still ENI was still there during that time. Again, FY14 hardly any revenues and losses. FY15 new guys came in. They negotiated deal with ENI. They wrote off 1,000 crores and or another 200 crores. So almost a 1,200 crore write-off was there at that time. Then these guys started focusing on a fine a D-Rock basin in which they had rights, and they started their work for D-Rock, and within 27 months or something of those sorts, uh, they started producing from D-Rock, and that came online in late FY18. So if you can see, FY19 numbers just shot up. So D-Rock started producing gas, and the numbers just shoot up. So you think of this company or this business as a step function of sorts. It's not a regular manufacturing or a marketing company where steadily things go up. It's sort of a step function. So when some well comes online, the profits and the revenues and profits shoot up, and they make a step. A similar thing on even on the other way. So if something goes wrong and well stops producing, then the profits come down. Now FY19 was there. PY1 also had some production, but on and off. So FY19 was one of the best years they had in a long time, and PY D-Rock was producing, PY1 was producing to some extent, and you look at the profitability just shot up from almost 40 crores to 150 crores. Now you still remember that they still have a tax shield. So this was a PBT and it flowed completely to the PAT. Now FY20 we will look at what happened to the gas prices, but PY1 again started showing some issues, and PY1 was not producing well. So again the profitability started coming down, and now the story also changes from here to how B80 will work out. So once D-Rock was stabilized and commissioned, they started focusing on B80. So last 2 years they wanted to commission B80 by before FY21, but it got delayed. It is still getting delayed. And FY22 they were not able to commission. Now B80 is in Arabian Sea. Okay. In They have a monsoon period from let's say end of May to early October. At that time the sea is very unsteady, and they cannot do the work at that time. So the large amount of works that they have to do, they cannot do that work. So if you miss that, what happened in May 21 was they were about to complete their work, but suddenly towards the end of the May, there was a cyclone called Taukte. Some of you might remember that cyclone came in and they had to stop all the work. So these guys have a lot of focus on HSE, that is health, safety, and environment. So if they have some doubts of some issue related to safety and all, they completely stop the work. So they stop work 1 week before that, just when they got to know that there is a cyclone coming. So they stopped the work, and just after the cyclone, the monsoon window started. So they had to stop the work for 4 5 months, and it got delayed further. When they started the work again, they had to mobilize all the resources and all. It takes much longer when you have to start again. Once once they started, they had some teething issues. Instruments were not working properly. So offshore fields in that sense are very difficult because you don't have control one over the weather at all. Second, you don't have, India is not a very big oil producing market, so you don't have a vibrant ecosystem which can provide you with all the equipments and all the manpower at the time that you need. So these guys are dependent on special divers which are limited in number in India, who specialize in doing this work. They are dependent on some vessels from ONGC and other fields around. So whenever they are available, these guys can do that work. So it's sort of very challenging. It got delayed from FY20, end of FY21. Then it was supposed to be done by FY22, but they started facing some teething issues. Towards for end of first quarter, they made of FY23, they made an announcement that they have commissioned B80, but again in few days, uh, due to bad weather, something happened, and then they were not able to produce from those assets. So that is the sort of difficulty through which this business and the management has to go through. So just wanted to shed some light of uh, kind of business that they are in, right? So any questions? I know it might be a bit complicated, but so shoot your any questions that you might have.
Yes,
Hi,
Chitresh
Manan.
has a question. You can go ahead,
Yes,
Chitresh.
yes, Chitresh.
So, hi, Manan. Regarding the B80,
Hmm.
as this is the very big part for HOEC, so I had few questions here. Like the first one was like when they announced the production of B80,
Hmm.
and then it was like regarding D1 oil and D2 gas, both the thing.
Right,
And then the gas thing, D2 gas was I mean working fine, and D1 oil, as you told, in 2 3 days it was stopped working. But
right,
management didn't tell anything. Before that, it gave so many management interviews and came in all the channels to say that both the things are working. But when it was not working, they were mum. And the second thing was
right,
that the gas was working for quite 1.5 months. I mean, till July 14th it was working. And after that also, when it stopped, I mean, there was no response from management. So anything on the quality of the management here, like when things are good, they come an announcement. When things are bad, they just don't tell anything to the investors. And I saw the HDFC reports and all, which came before the con call, and they knew about it. And in the report, they've already mentioned the wells were not working. So as a small investor,
right.
it was very difficult.
I agree. So that's a sort of lapse on their part. So I agree that is a problem. So communication or lack of it is a problem. Uh, but we have to understand one thing, that there is a spectrum of quality of management. So just like businesses have a spectrum, there will be like sort of saints, and there will be on one end, and there will be sort of chores on another end. So all the management lies somewhere uh, in between that spectrum of chore versus saints, right? So these guys have sort of issues communicating and all. But then we have to also understand that they are in the middle of something which is serious, very important for them, and it might maybe on purpose, or maybe just might have slipped out of their mind. I don't know, but that's a lapse, we have to agree. And you then just think from a sort, is it that they are completely off the radar, or is it some quality of management? It is not that I'll only invest in the companies which have the best quality management or which are like good in all the sense. If you look at these guys have a team of from the last annual report, 97 people, only 97 people spread across the country, and their focus completely is on BAT. They might not have a dedicated investor relations team who will take care of all these things. They are a very small setup from that perspective. So I'll give them some leeway and somewhat of a long rope when these kind of things happen. But you are right that they should be careful and cognizant, especially when it's a listed company.
Yeah, because as an
Right?
investor, we already raised it before in the previous con call also, and still like it's more serious this time because initially also when they announced that they will make BAT before 1 year, they didn't do it, but then there was no announcement or anything. After that also it was supposed to be in March, but that it didn't happen. So people raised a lot of questions, but again they are not understanding the seriousness of this, and as this is like a major impact for the company. So as per SEBI also, I think it's mandatory, right? I mean, if you have something this major happening, a closure or something, it should be announced in the BSE, and all the investors should know it at the same time.
I agree, Chitresh. That's completely perfect, completely right. But as I said, see, all of us, one thing have a choice, or management has lot of qualities. I'll come to a management quality slide. So there are perspectives in which we have to look at management. So if you don't mind, I'll park this question when we come to the management quality part for this company. Is that okay? Great. So, let's think about the business and the cycle first, and then we will come to the management quality aspect. Now, when a new government or NDA government came to power in 2014, uh, so before that the prices were sort of haphazard and all, especially gas prices in India. These guys brought in a administered pricing regime. Uh, so Based on that, they took four components of global gas, which is Alberta, Henry Hub, Russian gas, and European gas. All those prices they took combined, gave some weightage. So let's say they take prices of uh, all these four components from January to June, and they give weightage to those components, and they come to a conclusion, and they administer that price in the October to April quarter. So it has a lag of, let's say, 3 months or more, because that prices go on for every 6 months. They will change the price. So they change the price in October and they change the price in April. So April prices will be the prices of these four indices from July to December. Now, if you look at the graph here, they started this pricing mechanism in second half of FY15. So the first price administered was $5 per MMBTU, and then that price steadily came down. It came down to $2.5, then again went up somewhat. And this is the time when DROC started producing. Now in FY18. So then at that time the prices were pretty decent, and then again after post COVID the prices started falling, and they reached a level of $1.79 per MMBTU. So that was a big dip for all the companies. HOEC, the cost of production of HOEC is less than $1. So that's the sort of competence which these management guys bring in. They produce these are small wells also in a small institution, so they can afford to keep the cost structures low, and their ability to not invest, not sort of buy those assets at that time, and they did a tie-up with sort of Expro and other vendors, which gave them ability to produce gas at a much lower rate, which is less than $1 per MMBTU. Now, compared to that, ONGC and Oil India produce gas at almost $3.50 per MMBTU. Now, those guys were loss making for large part of last 4 or 5 years, and they made huge cash losses when the the pricing went to $1.79. Now later during FY22, these guys, government started giving marketing freedom to some players, and through marketing freedom was there, but it was not entirely free. So you have to auction the gas through IGX exchange, and you can get that some kind of premium on the market. So these guys auctioned their DROC gas and around last year, and then they started getting premium on that gas. So they're on an average they got a premium of $1 over and above the APM administered prices. So if the APM administered prices are $3, they will have the ability to get $4 from the market for whoever takes that gas. Otherwise, rest of the gas they will sell at APM prices. Now, if you look at the charts now, the global energy prices or gas prices are going through the roof. If you look at Europe, they are going shooting up, and if you look at US, they are also going up. So globally, gas prices are going up, which will be reflected in the subsequent revision of the prices. So right now in the first half, the administered price was around $6, and then it will further get revised. In my estimate, it should go. It should be around $10 for the next revision, which will come in October. So that's a huge upside for the DROC gas. So any questions on this?
No, Manan, I don't see any hands being raised. So I think one hand is okay. Wait. Krunal, I'm unmuting you. Just a second. You can go ahead. Krunal, you can unmute yourself and ask. I have sent you the request.
Okay. So my question is, the cost of production in DROC is $1, right? But what is the cost of production in BAT?
So we will come to BAT. BAT is a both oil and gas producer. So the cost is combined for the entire thing, and per day their equipment cost is around, if I remember correctly, 1.25 lakh US dollars. So that's the cost for entire production thing, which contains gas as well as oil. So their cost for overall per barrel oil equivalent, it comes down to around $15 per barrel oil equivalent. So it's combined for both oil and gas, from my estimate. Does that answer your question?
Krunal, does that answer your question?
Yes,
Okay.
yes, that pretty much answers my question. And if we talk about this B80, they've got the ability to sell it commercially, right, at a higher price, which
Yes.
they recently did with GSPC
Yes.
in the auction.
So BAT is not administered by APM price. So we will come to BAT. Now BAT is not administered, and they can auction that gas to whoever is the best price. Plus BAT has another advantage, that it will be delivered in Gujarat. So Gujarat is a very good gas market for all these players. Versus Assam. Assam is not a very big gas market until unless they are connected with a central hub, which might take some time. Assam has very limited set of people who or companies who offtake gas from there. Uh, so that might come in at a later point. But Gujarat is a very good gas market, and so just for the reference, they recently auctioned off gas from B80, which was around 22% of the previous month's average of Brent. So if the Brent average is 100, they get $22 for per MMBT of gas in DROC. So that's a very big number. Generally, if you understand, oil gas used to trade at a discount to oil in terms of energy parity. This has changed recently after Europe also acknowledged that natural gas and nuclear both will be considered as green fuels. So because of the ESG concerns and all, they were not acknowledging nuclear as well as gas as green fuels. But recently, last 1.5 years ago, they included gas and nuclear. So gas started trading at a premium to their energy parity. Energy parity generally is around 16% of crude. Okay, in terms of the amount of energy same thing can produce at at the same value. So if crude is $100, the same amount of energy can be generated at $16. So they both achieve energy parity at that. Now, historically, gas was trading at a discount to that energy parity. Now the gas has started trading at a premium to that energy parity because of its inclusion as a green fuel. Right. So these guys got the gas auction for a 2-year offtake, and GSPC won that auction, and they will be earning $22 22% of the previous month's average Brent, which is way above their cost of production. So initially, 2-3 years back, when this was not there, energy prices were also low. When I started understanding this company, I was putting the gas of B80 at almost $4-5, but this is a huge bounty that has come around. Right, so this is a big development, and if you think $22 is high, if you take gas from IGX, you will get it at north of $35. So the energy prices or gas prices on the spot market are way higher than that. But $22 for a long-term contract is a very good contract. ONGC also recently came out with a tender with a floor price of $15. So that's sort of a new paradigm shift in terms of the gas prices that we see. Is that clear?
Pranal, hope this is.
Yes, that is pretty clear. Thank you for clarifying.
Great.
Thank you, Pranal, for asking this question. So, Manan, there are more hands being raised. I'll just.
Please.
So, Avdut, I have sent you a request. You can ask your question now.
Good morning. Thanks for the opportunity. Manan, I don't get how they get revenues. That part I don't get normally whenever I come across this company. Can you simplify it? Because some part they can sell it into the market as per the APM price. There is a ceiling, and some part, as we were discussing now, that B80 there is no restrictions. How they make revenue? Can you simplify it a bit? And how much they can sell it to link to APM prices and not to APM prices? That part is a bit confusing for me.
Right. So, Avdut, what happened in 2019? Government came out with sort of a marketing freedom. So, the DSF auctions that started happening, DSF are nothing but discovered small fields. Let's say ONGC has a big field, B80, through which it is producing, but there are pockets of gas and oil around that field or through that field because it's a huge basin, but smaller pockets which ONGC cannot produce economically because it's too small for them. So those are the discovered small fields that government started auctioning off because they were just sitting and ONGC or Oil India were not producing from them. So they started inviting private participants to sort of get produce from there economically and sell in the Indian market. So the idea is for India to reduce its energy dependence outside. While there is gas, India has not grown gas production for last 10 years, and the production is sort of stuck or declining. Now the people who won DSF blocks, they have the government incentivized by giving them marketing freedom, so they can auction that gas off in Indian markets. They cannot sell outside, but they can sell in Indian markets at the auctioned off price. So everything before DSF started coming in, they were administered by APM.
Okay.
This is for gas. For oil, obviously all the companies can only sell in India, but recently they gave sort of, before imposing that windfall tax, they also gave marketing freedom to sell to any people, any company in India, even private. So ONGC can only sell to IOCL or something, BPCL before that, but they sort of gave the freedom to sell to anyone in India. So that was limited sort of marketing freedom. But immediately after that, they imposed a windfall tax also. So these guys, essentially the field DROC was from before DSF regime. So they have to sell at price linked to APM, but they gave marketing freedom of sort that they can charge auction that gas and charge somewhat premium depending on their demand for that. The idea for government is to increase the gas production from India. B80 enjoys complete freedom and they can sell. They don't have. They are not limited by APM prices. So that is what my understanding is.
Okay.
Does that make it clear?
Yeah. So what this company does is they have won this discovered small fields. They will set up their machineries over there, and they will start extracting it and sell it. So their initial investment is of this machinery, right? And
Yes.
over and above, they will extract oil and gas from there. They will sell it in the market, and they will earn the differential of cost of production and the
Yes.
market link price.
Yeah,
Is
so that is the business model of any upstream company or E&P, exploration and production company. So E part, like, is what ONGC or like other companies globally do, that they explore if there is gas or not. These guys don't do that part,
Okay.
exploration, because that is also very capital consuming part.
Correct.
You want to find oil, if there is oil or not. These guys are only into production, so they will go where they find fields and they can just start put in that machinery and start producing and that sell in the market.
Okay, understood. And how this economics differs in the case of offshore and onshore? Because I guess that offshore is much more difficult part than the onshore, right?
Absolutely. So even in APM regime, if there are difficult or deep water blocks or something like that, which are very difficult to produce and requires a lot of capital intensity, a lot of technical expertise to produce, APM has a higher price bracket for those also. So government also to some extent understands that deep water are very difficult. And as I explained earlier, they depend on the vagaries of weather, environment, lot
Correct.
of other factors versus onshore. And so one small incident I'll tell you, that DGH, like Department of Hydrocarbons, they conducted a sort of video conference for all the participants of oil and gas, all the bankers, companies, and all. They were there to get their feedback on what is happening, and it was sort of video cast also. I was part of that. Like, not part, I was like, I wanted to attend that, and I sort of uh, uh, was hearing the proceedings. From that, I understood a lot of people or companies complain that bankers, or like the corporate bankers who provide funding for these guys, don't have enough understanding, and that's why they don't fund these these projects at all. So
Hmm.
even onshore, they find it very difficult to get bank funding. Even when HOEC started, they found it so difficult, so they had to raise money from their promoters. They did not get bank funding. Only at later stage, when things stabilized, they started getting some bank funding. So that expertise of uh, because India has not been a big producer, always dependent on outside for exports, imports for energy. India has not developed that expertise, and most of the companies were large, and let's say for example ONGC and Oil India, they had government backing, so banks might fund that because it's the sovereign guaranteed, right? But other
Correct.
players found it very difficult to procure funding for these guys. So that is sort of an entry barrier, but that's a problem for India because banks don't fund these projects. If they don't fund, they are not lack of understanding prohibits them from taking these kind of risks. So that is a challenge. So for offshore, that is even bigger challenge.
Correct. As we have seen in the case of BAT, it took longer and they couldn't produce during the monsoon last year. That keeps on happening over there, and risk is as compared to banks, the risk is much more. And now also the I guess production has stopped, so
Absolutely.
it becomes very difficult. And what would be the quantum of initial investment and how they amortize it, or how they the treatment of it works? So, is that a huge sum
So
they have to put?
investments are in two forms. One is the amount or the money that is used for drilling the well itself. And
Correct.
second is the machinery that they have to put. They have to put in the oil rig. They have to put in. They have to get the FSO, which will store oil. They have to bring in other machinery. So that machinery will get depreciated over a period of time. So what HOEC has done is they have a wholly owned subsidiary, and in that wholly owned subsidiary has bought these assets, sort of second hand assets. They bought this FSO from a auction because Mercator Lines, a bankrupt company again, was selling that FSO very cheap. So they got in that FSO at around 50 crores. Then they got the rig that they are using. They found some old vessel, and then they refitted that vessel. So all those machineries ka cost is around 400 crores. The cost of drilling well is around 600 to 700 crores. So overall investment, from what I understand, in this asset is around 1100 crores. Now HOEC owns 60% of BAT and 40% is owned by a partner.
Adbhut or something that name.
Yeah. So
And
now that is also interesting story. So they initially bid for 50-50 partnership, but then other guy found it difficult to procure financing. So these guys then bought additional 10% stake for 70 or 80 crores around. And they now have 60 crores. So which again, in my opinion, was a good example of capital allocation because they bought it very cheap.
so in a sense, these guys are good at capital allocation from that buying, whether it is FSO or buying a stake at lower prices.
Yes. So I'll come to that when we understand management quality. So capital allocation part, we will discuss that also.
Okay, understood. Thank you for
Yeah.
elaborating.
Sure. So anyone else?
So, yeah, Manan, I see 3 hands being raised. So I'll first
Great.
ask Kailash to ask his question.
Yes.
Yes,
Kailash.
Kailashji, I have sent you a request. Please go ahead.
Yeah, hi sir. Actually, I'm the shareholder of this company as well. Actually, holding the share. Actually, I don't understand much, but actually, it's a belief that actually the kind of the management, changes that happen, and the kind of the player actually, they are actually. It's just, actually, it's a kind of a hope investment, but actually, I had entered at a very decent levels holding. So my question is very broad based, because what I am observing, the PNG bill that I used to get actually of my house actually has doubled since last, two bills. So actually maybe from,
Sorry.
the
What
June
bill?
cycle.
I couldn't understand. What bill you said?
Yeah, the PNG, the
Okay.
pipe
Okay.
natural
Okay.
gas bill
Gas
actually,
bill. Okay.
yeah, the gas bill actually, that I am receiving since last two bills I had received. Actually, it's exactly double the bill actually, and whereas actually the consumption pattern, there is no change. So looking at the trend and the way Warren Buffett has bought Occidental, and and the way he's buying, and maybe he's planning to buy, all out, actually, you don't know. So, and way you say the natural gas mix is changing. It is being considered as, natural gas, a clean, fuel kind of thing. So, and way the Ukraine situation and the Russia, Europe, the way the Europe has been sleeping for 32 years, actually, on a cheap gas from Russia, and the kind of the, pain that they are suffering, and the kind of the pledge, that they will be taking, that they will be, reshifting, actually their supply, and, and the kind of the, strain that will be causing the shift of, European, requirement from Russia to, other sources. So the kind of the, constrained supply, the squeeze that we can see in the natural gas market, and the way, this APM prices are fluctuating. So it's a very broad-based question. So kindly actually listen to it. Actually, these are all connected things. I need to put up that way. So the way the APM prices are rising, and the way the local industries would, getting affected, and ultimately, it would be very inflationary. So can there case, can there, because it seems that actually, this $9, US natural, gas prices actually, would be, very soon, maybe $15 plus the kind of the forecast that actually I'm seeing. So should I believe that actually, my PNG gas bill has doubled, and it is going to be again doubled? So, is this the kind of a linear, equation actually that is easier to, conceive, or, could there be any kind of mechanism that actually government has to bring in to protect the local industries, local manufacturers? Because, you said actually it's the APM prices that are there, but the free prices, in the free market, actually the spot prices, the EX, actually it's altogether a different ball game. So how long, and how you see the whole gas scenario, and government has also said actually the contribution of natural gas into the GDP is going to actually rise, actually maybe to 15% or 20%, or so. Looking at the broader picture of this gas, and the way Indian industry, a lot of industries are dependent upon the gas and the natural, the home-based consumption. So the inflationary aspect of it. So what can, what good can happen to it, what wrong can happen to it, and the global scenario is also absolutely stacked against this thing, and the Warren's Buffett, Warren's bet on this Occidental. So how you see the whole scenario? It's a broad-based question, I believe. Kindly be there.
Right. So as you said, it has many aspects to it. So one is what concerns India. Second is what concerns oil and gas markets themselves and the prices. So I'll from what my limited understanding is, over the last many years. So I'll take some liberty to give you some background what I have read about. Over last many years, the only growth in oil and gas, I'll talk about both of them together because a lot of wells are similar, and the kind of expenses and all required, they are similar. So whatever the production growth has happened in last 10 years has come about from the shale of USA in the global production market. So that is one thing. But the people who have invested in those shale assets over many years have not made a lot of money. So, billions and trillions of dollars have been put in those wells, but they have not had commensurate returns. Now, uh, add to that the ESG factor, right? So ESG, as some of you might have read, ExxonMobil, there was an investor called Engine Number One, holding 0.2% stake in the company. They rallied their forces and sort of tied up with institutional holders of Exxon, and they brought in two members of their two they introduced two of the board members on the Exxon board who are pro ESG of sorts. Now, because of that, Exxon Mobil has stopped investing or substantially reduce investing in new oil and gas. Similar thing happened with Royal Dutch Shell. So government from their one of the courts ordered that they have to reduce the spending on exploration of oil and gas. So essentially, what lot of these large players have reduced their spending of new gas. So any gas or oil well will deplete over a period of time, right? So you have to bring in new wells or drill in new wells to keep up the production, and to grow the production you have to do somewhat additional capex. So that is to maintain it, will you can call it a maintenance capex and then growth capex. Now when the oil prices were $100 last time around 2013-14, the capex that was happening for bringing in new oil and gas is was 3 or 4 times the current capex. So at that time, not 3 or 4 times, I think double. It was around $100 billion plus capex happening, and all the shale and all capex was happening. Right now, at similar oil prices, the capex is less than half. So there are estimates that the supply or the oil wells that have already been dug, they will peak out from production, and the production will start declining. And once it starts declining, it declines very fast. So that is one aspect. So not enough money has been put in oil and gas exploration over last 7-8 years, and these are not assets that you can bring online in like 1 or 2 years. Deep oil water takes like 10 years, and to address the delay part of it, so this is just a small thing. So when I started like getting that getting that those announcements that these things are getting delayed, I went back and read all that like 20 years annual reports of HOEC when PY1 was being brought on. So from that I understood that even PY1 was delayed for a long time. And then if you look at lot of global exploration, lot of these offshore fields, they keep on getting delayed because you cannot anticipate the problems that will come in this. So from that I sort of understood that you have to give some leeway to these people, because these people also don't have experience in offshore assets, right? This is the first offshore well that they are doing. So then you sort of become have some empathy towards the management and start giving somewhat of a long rope to them, obviously with the understanding that when it comes in it will do very well. So that is a small distraction just wanted to bring in about the delays. Now these are deep water wells and all, they take 7, 8, 10 years to bring online, and even onshore assets take 3, 4, 5 years. So even if you start doing capex right now, if you are able to do, because of ESG pressures, these companies are not getting funding or not being allowed to put in money. So if you look at Shell's announcements or ExxonMobil's announcement, or I think BP announced somewhere that they are buying a biodiesel sort of a plant, and that biodiesel sort of a plant will break in after 20 years. Now if you think any oil, if you do capex in that oil well, and if that oil well is decent enough, you will get your production break even within 3 or 4 years. So now lot of this capital is moving towards inefficient sources, right? So to understand that that one, we have to keep that in mind, that supply for oil and gas might be very restricted in times to come. And if you look at Russian history, Russia also had faced similar problems before 30, 40 years back. Once because Russia is a very cold place, so once you stop producing from that well, and that well freezes or something, it takes decades to bring that well. Like people have abandoned a lot of Russian wells which were shut down in 1989 during Gulf War, right? So you need so much technical expertise, and then US companies started entering Russia, and they were able to bring those a lot of those wells online back, but after a long capital infusion and long delays also. Now if that similar things happen in Russia, Russia's production peaks out, or even for that matter Saudi Arabia and OPEC countries, they have been talking about production growth, but none of them are even able to match that the quota that they have been allotted. So they are steadily increasing the output that they can bring in, but a lot of players are not able to do that. So there might be like the over capacity or extra buffer supply that we are thinking, it might not be there for all we know. If that doesn't happen, then energy prices might remain high for a long time. So this is a brief background about what my understanding of oil and gas is. Second aspect, you mentioned that India, the cost of energy in India and government has to protect the players. So if with the government policy, they are still protecting players by APM prices, which are not connected to global prices at all, right? So if you keep a cap on that price, artificial cap, that will blow up somewhere else. So that these price regimes have shown that India, none of the players are incentivized to increase the production. Now with additional, let's say, windfall tax that they brought in oil, people will not be incentivized to increase production, right? So then on one side, we want to increase our energy security, but then on the other side, we are disincentivizing the players to one produce for more production. Second, for bringing in external capital, because if there are erratic government policy moves, then external capital or external funding will not come in to be invested in exploration in India. So energy dependence will only increase, and if energy dependence increases, if you are capping your production or price, if global energy is trading or spot energy is trading at $35 and APM gas is 65, they can only do it for some government companies. Oil and ONGC will keep on producing, but other companies, private production will never come up, and ONGC and Oil India might not be able to increase production. It has been stagnant for a long time. So we will have to import the rest of the gas because demand of gas will go up. And if we are importing, that will be at market prices, which will be way higher than what India can produce. So this is one of the risk for Indian industry also. We have to keep in mind, and I think the energy prices, there is a large probability, I cannot be sure of, but I think there is a good probability that energy prices will stay high for time to come because new supply is not coming. And there is a dearth of energy in Europe. US, if US stops exporting, because US also has problem of energy, if US stops exporting to US stops exporting to Europe because its own energy prices are going up, then US prices might be stable, but Europe prices will shoot up like anything. And then let's say we import gas from Qatar, that Europe will compete for that Qatar gas with India and China or whoever, and those prices will shoot up like anything. At the current moment, based on oil parity, Europe prices are trading at 300 barrels of oil, $300 per barrel of oil in terms of energy parity. The gas prices are so high there, right? So it's a very tricky situation, and government has to like navigate this minefield in a very very nuanced manner so that Indian production goes up and imports stay stable. But I think we are in a regime for few years of high oil and gas prices. Kailashi, does that answer your question? I am sorry I took a long time to explain this.
Commitment. Yes, sir. Actually, it was really great insights, I would say. And, the lesson that I'm taking home is whichever other things that I'm holding, where gas is a key raw material. So I have to be very, very watchful. And so the other part actually that actually I couldn't manage to ask is, if for HOEC, if everything comes on parity, in the sense they come to the optimal production, so what constitute in terms of sales, the percentage of sales that they have to sell on an APM basis, or they can sell in a free market? So in percentage wise, the I want to know the in percentage. Suppose actually 100 they are producing, so 35 they will be selling at APM, and 65 in terms of that. Actually, could you please answer that? And sir, one thing that I would like to add, actually, you said about Exxon, BP, but the Total is a totally odd man out, actually. Total is totally, that's what my reading says, that Total is absolutely not obliging to any ESG kind of thing. And they are very aggressive when it comes to ramping up production and, doing the kind of things that industry may not like. So let's hope, actually, the demand will, drive other players to, bring, otherwise, actually, the way I believe Indian Titanic ship is facing a huge iceberg. That's what, I can sense, really, because the way the scene is staggered and the way the Europe, is facing kind of situation due to Russia and the shift that they are trying to make, and the Qatar that you bring that point. So it's really going to be tricky for India as well. And I believe this thing particularly is not being watched out, or any risk always comes from, where nobody is watching. So I believe, sir, there is a something, huge something is lying over there. But
Absolutely.
and
Absolutely. So,
Manan, before you begin, Kailash, so thank you so much for your questions. It's just that I wanted to share that there are two people also waiting in the queue. So you may ask more
no,
questions.
got sir.
I'm sure.
No, sir,
I'm
got
sure
it.
you have
Whatever
done
got it, I'm
you have,
absolutely okay.
no, you have done a lot of research. I understand and I know how deep you go into. So maybe you can come back again once the presentation
Yes,
is
yes,
over.
yes, sir.
Okay.
Absolutely, sorry, sir. Yeah, absolutely.
But do come up with your question, because I really enjoy the kind of research you do. So thank you so
Yeah,
much. Yeah,
yeah.
Manan, you can now answer.
yeah, so the short point is, from what I understand, around 25 to 30% after BAT comes online will be dependent on APM. Rest will be, because large part of oil will also come in. So that is also that also enjoys marketing freedom. So around 25 to 30% should be under APM. Rest will be rest will be free marketing, sort of. Hello.
Yeah, thank you, Manan. And so, Manan, there are two more hands being raised. So, do you want to
Yeah.
continue the
So no,
presentation?
we can do the questions, and maybe
Okay,
like some part of like already some part of presentation is already been discussed. So, but we can take up questions. That way, it will be more interesting for everyone, I think.
sure. So, I'm unmuting Madhav. You can ask your question.
Mananji, thanks for a very detailed company presentation. What I found ki this company is a very difficult company to research. So what triggered you? Was it underpriced assets and tax arbitrage? And when was the trigger? Russia-Ukraine war or before that to buy this company?
So Madhavji, the trigger essentially was management change which happened in 2015-16. So I was tracking this company, but at that time I was not able to understand, as you said, that it's a very difficult company to understand. But for me, the real trigger happened when the oil and gas prices went very low after just when the COVID happened, right? So oil went negative for a few days, I think. At that time, this company this company really got me interested. This company became very cheap, and from my understanding, that it became so cheap that it was less than a value of even one asset. Like it was less than the value of BAT if things work out, and then you got all the other assets and the management capabilities that they bring in for free. So that was the real trigger, which when I started doing a lot more work on that.
Yeah, Ukraine war was a rather bonanza for you because after that only the gas prices really spiked up.
So, sir, idea was, as I discussed, the gas prices were going to spike up irrespective of that, because the demand, because of COVID, transportation, aviation is not still back fully. The demand was not there, but the supply was also reducing. So Ukraine, Russia just triggered it, but that bomb was already in the making. Ukraine Russia war just triggered that war thing. But yeah, that was also a good opportunity. in my opinion, it's still a good opportunity to look at this company.
In correlate to this, I have got a very basic question. In the framework, you said that you search for underpriced company, which is a relative term.
Yes.
So how you define the underpriced companies? And second to that, what is your strike rate when you search for such companies? Suppose you search for 100 companies in a year, how many such companies you find out which are investment worthy? And what is your return expectation over 3 to 5 years in those type of companies?
So, sir, both your first and third questions both have I'll take up later if you don't mind.
No
Second
problem.
question, so I have that in this presentation itself. So we will discuss what are the risk reward for this investment over next few years, and why it is undervalued. So that is also there. The second strike rate part is very difficult to say because over a period of time, sometimes you work on a lot of these companies and you don't find anything interesting. But sometimes it happens that you work on few companies and all of them you find interesting. So it's sort of, there is somewhat randomness built into that.
Yeah, but Manan, I would just like to chip in here. So, Mr. MP Bajaj, Dr. MP Bajaj, knowing how Manan invests, I can just say one thing to maybe answer your question is that there could be 8 companies which may not work, and then there could be 2 companies which will work in such a way that it will completely lift your portfolio up. So that is how it works. So strike rate might appear to be 20% only, but actually your portfolio performance can go up really well. That is what Manan, I hope I could explain it in a good way.
Right. So I try to that's correct about the strike rate of the portfolio itself. So I understood question as the strike rate of finding good companies. But I'll talk about, when I talk about portfolio construction, I talk about how I mitigate those kind of try to mitigate at least those kind of risks when it comes to strike rates. So we'll talk about then when we, if and when we discuss portfolio construction. So I think
Okay. Thank you, Manan. Thank you. I got it.
sure.
Thank you so much, Dr. Bajaj. Those were some really good questions, and we'll take up your other portfolio related questions in the end as well. So we have one more hand raised. Chitresh. Chitresh, I'm unmuting you. You can go ahead.
So Manan, you talked about the pricing and the freedom of the pricing. How about the royalty, Manan? Could you throw more?
So they have to, depending on the kind of asset, anywhere between 10 to 15% royalty is there. So royalty, there are few kinds of taxes or revenue sharing. So royalty is one straight away 10 to 15% depending on the kind of asset they have to pay directly to the government. Let's say oil price, they are selling at oil at 100. So they have to give 10% of that flat as royalty to the government. So that is one form of tax. Second form of revenue sharing is when they have a revenue sharing formula. Let's say in this case they go from 12% to 55% for HOEC. So if the revenue per day is there's a formula for that, okay, but the revenue for the day is around $1 lakh, $1 lakh, then they will have to pay 12% as revenue sharing. If the revenue goes beyond $1 million per day, then they will have to give 55% as the revenue sharing. So and anywhere in between you have that sort of formula which will calculate what kind of revenue sharing that they will have to give. So that is royalty plus revenue sharing, especially in this B80 field. Does that answer your question, Chitresh?
I think Chitresh has left, or no, maybe he has muted himself. Chitresh, you
So
can again.
yeah, sorry, I was not able to unmute myself. Manan, my question was like regarding B80 majorly, like any idea like for like gas prices, or I mean for the crude prices around $80 or $100, what would be the royalty so that we can at least come
10,
up with the
10,
profit
10%.
number?
10%.
So if the
Royalty
oil
is 10% flat.
if the oil stays at $80, it would be at 10% royalty.
Whatever the price is, $8, $80, 800, they have to pay royalty of 10%. But then there is profit revenue sharing agreement, which says that if the revenue per day is 1 lakh, they will have to share 12% of that revenue. If the revenue is 1 million or more per day, they will have to share 55%. And in their presentation, they have given a formula on which it can be calculated. So if, let's say, revenue is somewhere around $500,000 per day, then it will, the profit sharing will come to around revenue sharing will come to around 30% or something. But royalty is flat on whatever price you sell.
Okay, by royalty I meant what will go to government. Like, if $80 is the price and we assume $15 as the cost of production, so what are the other charges they have to
It
pay?
doesn't depend on cost of production in this case. Pehle it was that profit sharing or all this. Now it's flat revenue sharing. So royalty plus the formula of revenue sharing that I explained right now. So all that part, let's say if based on the formula, it comes to around 30% of the revenues. So 10% plus 30%, 40% goes to the government directly from the top line. Remaining comes to this company.
But then government is not not giving incentive to produce more, right? It's giving incentive to produce less.
Yes, so that is the problem with the formula.
Okay. Thanks, Manan. That answers my question.
So any other questions?
I don't see any more hands being raised, and you have been
Okay.
answering questions for a long time now. So
Yeah,
maybe
sure.
we
So
can
let's definitely.
move ahead with the presentation.
Okay.
Yeah.
So now one thing happened in B80 was when they bid for this asset, obviously they would have known to some extent that the reserves are much more. But when they started drilling wells, they got more data. They got it verified from an external agency. The reserves of that well were way more than what they anticipated. So as you can see here, based on when initially the data was there, they had like 3.35 million barrels of oil and 17 BCF or billion cubic feet of gas. Based on the revised data, there was like 15 million barrels of oil and 40 billion or 39 billion cubic feet of gas. So that was the upside that came through when more data came in. Now, when they start production, they will get more data about well, and then they will understand if they can produce more from the same well or not. But that is the sort of thing that was unanticipated and positive surprise which came through when B80 they started drilling wells and all. So just wanted to highlight that. Okay. So now when we were discussing about the management quality, uh, there are these four aspects in general that I look at when I try to understand management quality. So one is integrity, second is competence, third is capital allocation, and fourth is skin in the game. Integrity is obviously how you treat minority shareholders and other stakeholders and other related parties, your employees in general. So in this case, as Chitresh also pointed out, they had these lapses in announcing to the market that the field is not coming in. But apart from that, they have generally been upfront when they discuss and they accept all their problems. They have been transparent with the con calls. Apart from obviously the few lapses, they did not immediately announce that this field has stopped or some problem is there. So in that sense, they might have been indulging in selective disclosures. So to some extent, that integrity has been like you will give somewhat less marks to the management for that integrity. But in general, they have been decent enough to do con calls and all through like throw clarity on whatever the problems that they face. Second is competence. So one very significant area was like the way they brought. So when Elango joined, Elango was the guy who we have to understand that he's not from a technical background. His education was in humanities, but he started with ONGC and entered this technical field, and then went to Kane. And Kane, he was the guy who he was the leader when Kane was started producing from Rajasthan. So he has that understanding of the nuances of the business. Uh, from what I understood, their ability to get $1 premium in Diroc, that was also one of it. Was very difficult, but they they got it done. Secondly, the cost of production in Diroc itself, they designed the well and the production thing in such a manner that they brought that in fast, plus at a low cost. Even if we talk about B80, uh, uh, their cost of production is around $15 per barrel of oil equivalent. So which is extremely cheap compared to even global standards. So that's the kind of competence that they bring in. Obviously now delays have happened in B80, but from what I understand, delays are the part of this game in especially offshore fields. So with that in mind, these guys have shown very good competence throughout their tenure, even before joining HOEC. In terms of capital allocation, they have been very good. They bought the asset themselves very cheap at like almost 30 rupees per share when they got into HOEC, and then they negotiated deal in such a way that they got almost 1500 crores of assets which were written off on the books. So their value on books is zero, but they still have those assets in place. So they can, at some point when they start producing from PY1, those assets will reap dividends, and obviously those assets are zero on the books. So your return on investments, return on capital employed will be very high. Plus you enjoy the tax shield which that gives. So that's also a big advantage. Secondly, they have always been very cost conscious in doing their capexes. Now the beautiful example for that is they bought all the assets second hand, got it refitted, and all those assets are now and part of their subsidiary. Now when the company and that those subsidiary has contracted with B80 for giving those assets and getting rent. Now from what I understand, total cost of B80 production is $125,000 per day, of which the subsidiary itself for renting their assets get almost $90,000 per day, and out of that, $25,000 $35,000 a day is expense. Post expense, they can make almost 150 crores of PBT from that subsidiary. I think that is largely underappreciated part of the valuation at this point, because that is irrespective of the oil price fluctuation. The contract is for 7 years, and later it might get revised also. But for 7 years, there is a revenue stream or profit stream of 150 crores which can come in, and they will do accelerated depreciation, which is allowed in this case, so their taxes initially will be low. But we are talking about EBITDA of almost 200 crores and PBT of 150 crores in the first year when the full production starts. Now the gross block itself is 400 crores. So you think about payback time is less than 3 years. It's a brilliant thing. And because they own these assets, and if some like B80 gets delayed, they can still it brings in the resilience that they don't have to struggle to pay their contractors very fast. Once that asset comes online, they will start paying that subsidiary. So that brings in the resilience to some extent, right? So in my opinion, it's a very good example of how shrewd they are in terms of allocating capital. And then, as discussed initially, the skin in the game for this management is sort of a bit low because they own only 7.5%, Mr. Jiva and Mr. Elango. But from what I understand, that is most of their net worth is invested in this company. So,
So, Manan,
yes.
there is a question related to management quality asked
Yeah.
by one of the Mission Smile members who unfortunately couldn't join the meeting today. So,
Okay.
shall I ask that question
Please,
now,
please.
or shall we wait for the this one?
No. Please ask.
So, this is a question from Vikas Kasturi. He's a good friend and also a Mission Smile member. So, this is what he says. It's a slightly long, and a part of it has been already been covered by Chitresh also in one of his previous question. But I would like to read this out because I think Vikas has explained this point in a very beautiful way. So this is what Vikas says. I'm just reading out what he says. I have heard the management of HOEC talk for nearly 2 years now, and my sense is that they tend to overpromise and underdeliver. In December 2020, they said that the B80 well would be operational in a matter of few months. Then in April, May 2021, we were hit by a cyclone and work had to be stopped. The management made it a point to say that we were just 1 week away from commissioning. Then after the cyclone, they said we have to wait for the monsoons to get over. Then after the monsoons, they said we are just 1 month away. In fact, somebody asked, before you said you were 1 week away, now you are saying 1 month away. Then they announced the Q4 in the Q4 FY22 on the last day possible. I'm thinking this is to give themselves more time to announce the good news. Even after commissioning in June 2022, it had to be again shut down for repair. As of 26 August 2022, B80 well isn't operational yet. All we have is their word, and you know how that has played out. I like managements that underpromise and then deliver. They don't give projections and timelines. When it gets commissioned is when it gets commissioned. Analysts don't like uncertainty, so that stock prices don't rally, etc. But they deliver for the long term. However, the way Elango talks reminds me of the time I hired a plumbing contractor, and he was a sweet talking fellow, but he always slipped on his deadlines. For example, these were these are the excuses he has given me. His son would go missing, his mother would have some issues, his father would have some issues, his phone would stop working, and there are several other. I'll not read those things. What he said that in the end is that I gave him multiple projects over the last 3 years, and the experience was the same. I used to think, poor guy seems genuine, let's give him one more chance. And I finally stopped doing business with him. So this is a uh, very good way to put it forward. As in, this is always a dilemma, not just for HOEC. I personally have also felt for some other companies in which my company and my investors are also invested. So what would be your take on approaching this kind of a situation?
Okay. So definitely I agree with all his points of view, but see, we have to look at things in context. And I might be a bit generous when I'm talking about this, but they have delivered in the past as well. If you look at the base rates of the entire industry globally, there have been delays always. Saudi Arabia, for example, promises that they can do 12 million barrels of oil per day, but they are not able to reach beyond 10 and a half, right? So these assets, these are the things, and there was a lovely thing put in by my friend. I read about it, some quote by some person about the man in the arena. Now I can sit here and say that Sachin Tendulkar should bat like this or like that. He doesn't know. He gets bored. He gets this, that. But I am just a spectator or a commentator without understanding what kind of situation that he goes through, right? Sachin Tendulkar himself is the man in the arena who is going through all that. So it's very easy for me to comment on all these things. And as a shareholder, buying, like I, to some extent, I understand the problems that these guys face. But only when I step into their shoes, I'll really be able to find out what problems are actually going on. And this is the first time, like how many companies in India is doing offshore? ONGC, Oil India, and Reliance. Even Reliance faced issues. Reliance at their capabilities, they were not able to produce from KG Basin. So India doesn't have expertise. So in my opinion, we have to give them some sort of a leeway. And obviously, it's a choice of an investor to wait it out. If you feel uncomfortable with the uncertainty, it's a choice that you wait it out and let BAT be stabilized completely and maybe then join in the journey. So it's very easy and liquid for us, right? I can just go and press sell button and be out and sit comfortably and wait till the BAT comes online. So the risk that I am taking is I might not get the price at that time, but I'll get the certainty. So I'll approach in that manner. In some cases, I might be uncomfortable holding on to it before the thing actually happens. In some cases, for example, in this case, I I am more sympathetic to this guy than I might be to others. So I am willing to wait it out. And for me, I think I might not get the price that I am getting right now. Obviously, I have been invested for almost 2 years now, and I have added positions through the way. But because of this uncertainty, you might be getting the price that you are getting. Because this company traded at 160 rupees, which the price is currently, even when the oil was much lower. Even when the BAT was not there, just DROC was producing and PY1 was producing to some extent. They traded at 160, and I'll show you the share price chart also. But right now, at these oil prices and this gas prices, companies still trading at that, which shows that market is pricing in the uncertainty of management not being able to deliver. While on the other side, I am saying, I'm betting that it might be delayed, but management might deliver a year or two or some like time later. So I'm willing to take that risk. If you are not willing to take that risk, you just you can wait for the asset to start producing. But in that case, you might not get the price or even get a better price. I don't know, but I'm just saying. So I am not willing to take that chance that price might run up once the asset starts producing, because it will be a huge step function in terms of their PNL once the asset comes online. So I would approach it in that manner.
No, that's a very, very, very well thought out answer. I was not expecting your answer to be so that good. And I just wanted to add something like this, Manan. So I don't want to name the company. I don't want to play my book over here right now. But so it has happened with me also in one of the companies. Of course, the business over there was far more simpler compared to HOEC, but where the management always used to be very optimistic and used to under deliver on the whatever target they used to. So it actually it puts you off as an investor, that why you are giving those kind of targets. But when you look back now after 7-8 years of their performance, even if they fell short of their guidance, they actually ended up doing pretty well. So that, if I would have, say, probably thinking of those things and got out of of that company, I would not have enjoyed the returns over the last. So this is always going to be a dilemma, and there is no right or wrong answer to this. That there is no binary that you do this and you don't do this, because you can never be sure about the outcome. So as you very beautifully put, either if you want more certainty, you can wait for that to play out and then pay higher price, or if you are willing to take a chance with the management, you would probably take the lower price today, because that gives you a higher probability of better returns if things work out in your favor. So that according to me was probably the highlight of today's session. Thank you so much. I see Chaitanya raising his hand, so I'll just unmute him. Yes, Chaitanya, please go.
Can you hear me, sir?
Yes.
Yeah, please go ahead.
Good morning, sir. That was a great presentation, sir. So I just had a question in relation to the 150 crores PBT that you talked about from the equipment that HOEC's wholly owned subsidiary owns. So, sir, in addition to this, can you also give the breakup, like what kind of PBT can B80 produce from the gas and oil that they have said? Because like from the past con call transcript that I've read, they've said that they'll produce 10 mmcd of gas, that they will extend it up to 15, and then oil. I was like, that was pretty confusing. Can you clear that up, please?
Yeah, so that will also come up when I present about. It's part of the presentation later down the line.
Okay,
So
okay.
I'll
I
come
thought
to
like the
that.
presentation was ending. That's why I was questioning.
No, no.
Okay, thank you so much, sir.
Sure. So I think we have talked enough about management quality. If there are no other questions, I'll move ahead.
Yeah. Please go ahead, Manan.
Okay. So for any investment, in my if I want to allocate a decent amount of money to any investment, I would like to get some optionalities added to the thing, right? So when optionalities are like free lottery tickets that you get along. So in my opinion, there are a lot of optionalities built in HOEC, for example, like higher oil and gas prices, which already played out to some extent, and we don't know where that can lead up to. So that is one optionality. Obviously, it's a double-edged sword, and it can go down also. But I'm saying, in my opinion, there is a chance of oil and gas prices remaining higher. So that's added optionality, and especially an optionality when I was investing in the company at $50 of oil. Now, as we got to know from B80, the reserves were much higher than initially anticipated. So over a period of time, when they start producing well, producing properly and stabilize the production, we might get more data, more insights into the well, and there might be chances of even higher production from B80. So that is another optionality. Then there is DROC, which is going to expand its thing, and it will happen over two-year period. But production from DROC will also go up. And then there is a greater DROC well also that these guys own, which has even more capabilities, which they will bring in when Northeast market is connected to the central grid for gas. So that is another optionality. We are not paying, and mind you, we are not paying for any of these optionalities at this time. Okay. PY1 production, again, as I told you, if it comes online, all the assets are there. You can start producing and enjoy a very high return. Obviously, they will have to do some capex related to that, but then it's there. Right now, I'm not paying any price for that. Then there are some other assets which they might, which government might auction off at a later date, and these guys might be able to get, which might take the company to a different level. And sector or multiple re-rating, which will happen when people realize that oil will be required for at least 10 years from now. Because right now, one thing is, because of ESG, the entire sector is tremendously underrated. It might or might not happen. All these optionalities might or might not happen, but I'm saying we are not paying a price for these optionalities. Again, when BAT starts producing and the production stabilizes and improves, the uncertainty related to the management quality or the competence will reduce, and that will also help multiple re-rating to some extent. So all these are optionalities which we get in and are sort of free. And if some of these plays out, we can make a lot more money than we anticipate right now. So that is on optionality. Any questions on this? I'll move on.
I see again 3 hands being raised. Shall I take the questions or you want to move on?
No, please.
Okay. So Dhruv, you have asked for the first time, so I'll unmute you first. Yeah, please go ahead, Dhruv.
Hi Manan, thanks for the wonderful presentation. The good part is I now as someone who shares a similar macro thesis on oil and gas space like me, and happy to discuss later on. But I think in the next slide you're covering my biggest risk for this thing, because that is the HDFC large seller, which is a big overhang for the stock over the past 1 year. Because every time the price goes up, they come and they just dump. And I believe, from my understanding, because of the merger, they will have to compulsorily sell it off this time because of the regulatory issues. So, any insights on that? You can cover it later, but yeah, I can wait. Thanks for the presentation, though.
Sure, thanks. I'll cover it in the next slide.
Sure. So I think next online is first Chaitanya. So Chaitanya, I'm unmuting you.
Thanks again, sir. So this was in regard to the multiple re-rating thing. So I know that there's a windfall tax on ONGC and Oil India. So I also share a macro view on the oil sector, sir. So I had been invested in Oil India and ONGC, and it was running up quite nicely till the windfall tax was announced. So, I understand that HOEC doesn't have, because the limit is 2 million tons of oil production. But still, sir, ONGC, even at the cap of $75 per barrel, is going to be rated at, I think so, it's like 3 times cash flow, even at $75 per barrel. Because in third quarter, they had a PAT of 15,000 crores. So, and they have a depreciation of 5,000. So that's a cash flow of, I think, 3 times cash flow. And so don't you think that ONGC will become really cheap at 3 times cash flow? Rather than investing in HOC, shouldn't we be investing over there?
See, so I am biased towards smaller companies, or I am biased against larger companies, so to say. You are right. See, ONGC is also cheap, but the kind of upside that I might get from HOEC, in my opinion and my biased opinion, I think that can be much bigger than what I can get from ONGC, because government is not going to sell ONGC. If there is a chance of disinvestment, then I might think of ONGC also. But it is going to be a PSU management for a foreseeable future, and I don't see any reason why government will disinvest that. So and PSU has their own discount. PSU valuations across the board have their own discount. So I think if HOEC starts producing, it can trade at a higher sort of multiple than ONGC, and my upside in terms of percentage can be much bigger. Second thing I want to add is, see, ONGC is a well covered company across the board, like institutions, large institutions, FIIs, DIIs, analyst community, sell side analyst community. They all cover ONGC. And for me to add some value to that, all the smart people covering this, my ability to add value to that is much lower than my ability to add value to HOEC, because hardly there is no DII holding, right? There are no analysts covering this company. So I think there is a chance that my ability to add value and discover underpricing in HOEC is much more than ONGC. So that is the reason I would play this sector through HOEC rather than ONGC.
Thanks, Manan. I hope Chaitanya, you have got your answer. So I'll just unmute Chitresh again. Yeah, Chitresh, please go ahead.
Hi, Manan. Sorry again. So my question was regarding the oil production here. So initially, I think today, without BAT, the HOC's net oil production, I mean, HOC share is around 2,500 equivalent oil barrel, I believe. And with this BAT going, it might increase to 7,500 equivalent barrel.
Yes.
And with the all other fields like PY1 and DROC, I think they are planning to take it to 1500, 15,000 barrel equivalent per day.
Yes. So they are not planning as such. They have that ability to go to 15,000 from the current assets that they have. That's what I understand. So initially when management came in, they wanted like within 5-7 years, they wanted to take the production, gross production, which is around 7.5 to 8,000 right now, to 25,000. So with BAT, we will largely reach somewhere near that mark. And with other fields, if they come in, that can be an additional kicker for us.
Because management's earlier guidance before 1 year was like, they will do this also within 2 years. But like as BAT getting delayed and the cash flow getting delayed, like by when do you see like, this actually happening?
See, right now, it's very difficult for me to say कि ये कब होगा. But if you look at the recent announcement, they have announced that they want to raise funds, right? So what my understanding is, for BAT, they don't need any funds now. The fundraising, if that happens, and that might just be an enabling resolution, it might be to start other projects before the BAT cash flows come in. Because if they wait for BAT cash flows, that might take like 6, 7, 8 months from now also.
Oh, but
What?
उन्होंने बोला था कि BAT में they have required like a lot of capital and they're having capital issues now. I mean working capital issues now.
The working capital issues, as in, see, they have to pay for their expenses and all that. If the production doesn't come in, they have to still keep on paying for their expenses. So that is the working capital issue that they will have to face, because oil they will not sell it immediately. They will have to store oil to some extent in their FSO, and it will be 2-3 months. Once in a 2-3 months they will sell that oil, so they will need working capital for that also. So BAT, from what I understand, capital expenditure is not required, but they might require working capital till the time it stabilizes. Once it stabilizes, then all the issues related to capital are sorted and it will start throwing a lot of cash out. But they can manage from the current setup that they have. But if they need additional capital for other things to invest in, for example, DROC, they got environmental clearance and all those things. So they will have to start laying pipes and all. And there is no reason for them to wait, because we are in a high price environment. There is no reason for them to act sequentially. They should start acting parallelly. So that was one reason that I felt that they lacked hunger, and BAT pay, they were like sort of stuck for a long time. They were not doing anything else apart from BAT. But now with this, if they raise capital and choose to invest in other projects, then it might open up other avenues, especially when we are in a high price environment.
So
So
this
they
is what
should
we're talking about, Greater DROC, right? I mean, which they got into
Greater DROC and
recently.
the pipeline they have to lay from this DROC to then Dhuliajan junction, which will open up marketing avenues for them. So Greater
Oh,
DROC is also there.
so great. If this happens, it will be good for shareholder. I mean, hope this is
Yeah,
the
hopefully.
need way for getting the
Yes,
money. Yeah.
yes,
Thank you, Manan.
sure. Any
Thank
more
you,
questions?
Chitresh. Avdut also has one question. I'm unmuting him.
Yes.
Yeah, Avdut, please go ahead.
So BAT seems to be a start of virtuous cycle once it starts working for them, right? But right now the uncertainties. So on two front, how much production, when it will start, that's one, and second, the management, that people have expressed their opinions about management. So how we can play is what in our control is. First is valuation, then the portfolio allocation. I would like to know how you play it on your front, because these are the two things I understand in our hands. Other things we can't control, right? So how do
Yes.
you look at it in that two aspects that I would like to?
So, Manan,
Okay.
before you answer, let me just clarify this question. So, you might have been investing in HOEC since the last 2 years. Say, just see it hypothetically that you are not a shareholder today. And if you would have looked at HOEC today at this price, assuming that you didn't have any previous holding, how would you approach HOEC? And just to flip the question of Avadut a little bit, what would be your allocation today at this price is what we would
See,
be.
yeah, I understand. The uncertainty we are talking largely in my mind, the uncertainty is related to the timing of production from BAT. That is, in my opinion, the only uncertainty, and that uncertainty gives you the price right now. So even if I am to invest at this point, I'll start with I might not start, like for a lot of companies, I start with a smaller allocation, let's say 2 or 3%, sort of a tail position for me. And then if they deliver, I keep on adding up. In this case, because if that uncertainty goes away, all of a sudden there you might be like trading at much higher price. This is all hypothesis and assumption. I might be completely wrong. Okay. But I'll start with a decent enough allocation even at this point, knowing the only uncertainty here is the timing of production. They have clearly mentioned that well is in a very good shape. The well may PY1 stop because of the well problem. The equipments were okay there, but the well was not good enough. In this case, the well is good because they cannot do anything about the well. If the well is a problem, then you will face much more problems. But well is in a good condition. Only the equipment that is above the surface, that is the problem, which are resolvable, and the only factor is time. If at these oil prices I am getting HOEC at current rate, knowing that there's a subsidiary which is underappreciated, which can generate a good cash flows over next 5-7 years. I'll still start with a higher allocation because these are the kind of plays that I like where uncertainty is high and there is disbelief in the market. So I might still start with a higher allocation, not very high allocation, but still around 5 to 7% I can start with. So
And
this is just I take like I am a risk taker, or I think I am a risk taker. So I'll take it with a pinch of salt because entire, as Ankit mentioned, every penny that my family has is in the equities and 10 to 15 stocks. So I am like I don't have any mutual funds or anything at all apart from this. So the risk taking also comes into play here, so that you should be able to sleep with the position if things don't work out. So that is one big factor that you have to factor in.
And initially, when you started, the initiation point was it was trading below the gross block or the investment 1100 crores that they have done in the BAT, right? That was the initiation point.
Yeah, so initiation point was around 2 years back in June 20 when the oil prices were very low, around 60 rupees or something. That was the first buy, but I have bought all along the way. So yeah.
Okay. And the valuation wise, the metric you looked at, or it might have came up on your screen, was because of that gross block
Yeah, see,
trading.
in this case, I'll come to that, but valuation is very tricky in this case. You cannot value because if those assets don't produce, you cannot value it.
Mm-hmm.
There's no point in valuing those assets. So gross block is useless. PY1 में assets है, infrastructure है, but if that PY1 doesn't produce, that infrastructure is not fungible or can be moved somewhere else, or it will take a lot of cost to do that. So then
Okay.
there's no point in valuing that.
Based on assets.
Yes. The only factor of valuation was that if and when BAT comes in, and if and when oil prices go up or gas prices, APM gas prices, which were $1.79, which was rock bottom, if they go up, then even DROC starts producing cash flows. So that was the basis of valuation. And if things work out, BAT comes online, which has been delayed. But if it comes online, you are a step function. You like climb a huge mountain, and then your cash flow starts from there.
Then in this sense, tracking the gas prices and the gas scenario over the world becomes much critical, right?
Yeah, it is important for you to have a view on the gas prices.
Understood. Thank you. That's it from us. Thank you.
Sure.
Manan, there is one question on the chat box by Mr. Rajiv Agarwal. He's also, I know him for more than 10, 12 years now. And
Wow.
he is a very sharp investor from Kolkata. So I think he would be investing since more than 20 years. He asked us why it is raising funds again, announced a fundraising plan a couple of days back.
Yeah, so I think so even I am not very clear on this. One thing, it can be just a enabling resolution where they want to get it passed along with the AGM, because AGM date is still not out, and they might want to exercise that ability to raise funds later. Second thing is, as I mentioned to Chitresh, they might want to start expanding in other fields simultaneously while BAT, the problems in BAT get sorted out. Because right now they don't have extra capital to invest in the other companies. BAT has taken most of it. So while the energy prices are higher, it makes sense for them to start investing in other assets, because these assets all take like a year or 2 or 3 to come online, and along with the delays. So I think then it might make
Rajiv,
sense.
Rajiv, I have unmuted you. You can ask if you have more questions.
Yeah, thanks for this wonderful presentation, Manan. It was a very good and insightful presentation you have been. Actually, this company has just come on my radar also because of the high gas prices. And like you, I had invested in ONGC when oil prices crashed at 60 rupees. So now that ONGC thing, I cannot invest because of this windfall tax. So this.
So I sorry to interrupt. I have not invested in ONGC at all. I invested
No,
in
no, no.
HOEC.
I was talking about myself. That
Okay.
like you, I had invested in ONGC when the oil and gas prices were down. Okay.
Fine.
So this company I couldn't cover. So now this smart thing started covering it as per agency, and recently it came under my radar also because of this high gas prices. So I decided to join this presentation, and so far you have explained everything in very good detail, and it has allowed me to start tracking it. So I just want to say my sincere thanks to you and Ankit for bringing up such nice ideas for ordinary investors like us to make some good money. Thank you.
Sure,
Thank
I'm
you.
happy
Thank you
that
so
it is
much,
helpful.
Rajiv. Thank you so much. I don't see any more hands being raised, Manan. So you can continue.
Yeah. So I think a lot of risks we have covered. One is obviously regulatory risk, which government can bring on windfall tax on gas also. They might choose not to revise the gas price. So all those risks are there, and we have to sort of live with that and allocate or allocate at valuations that we want, which covers this risk. So regulatory risk is one, and we have very high government intervention and regulatory risk here. Another thing I want to mention is, while one part of the government is sort of maybe finance ministry wants to benefit out of these windfall taxes, another part of ministry, that is Department of Hydrocarbons and all, they have been expediting this process of giving clearances and all. So to some extent, at least one part of government is working on to help private players participate better. So that's a little bit of offset for that risk. Second is asset concentration. As we know, delays happen, BAT production doesn't happen, PY1 goes off. So those are the asset concentration risk. It's not like the production is spread over multiple fields. If something happens to BAT, then again, you might not even get an exit. Then there is oil and gas prices, which are very unpredictable. In general, my opinion is over next few years, the oil prices might stay at elevated levels, or energy prices in general. Key man risk, Elango, and I'm not sure if they have been able to develop a management bandwidth who can sort of run multiple assets at the same time. And if you are dependent too much on the same guys, it becomes a big risk if they choose to retire at some point without having enough management bandwidth that can be so that company can run smoothly going forward also. And especially because these guys are smart operators and capital allocators, that key man risk sort of increases. And then there is one thing that keeps on coming to mind, that hydrocarbon or oil and gas, entire all the transportation will become electric or hydrogen or whatever. So hydrocarbon obsolescence is a risk, but I think that's a risk for a longer term, and it might play out in a much longer term than we anticipate. So in my opinion, oil is still here to stay for at least next 5 to 10 years. And as someone asked, HDFC has been a big seller. So that will be sort of overhang on a stock. Whenever stock prices go up, HDFC might want to exit. And obviously because of this merger and all and ESG concerns again, they are planning to exit. So that is a sure, like around 6.5% of the price of the stake is going to get offloaded in the market. So at some point that will happen, and they have reduced it from 11.5 to 6.5 now. But if that aligns with BAT coming online, then I think that risk reduces to some extent. But if BAT gets delayed further and these guys are wanting to sell, then the stock price might face that brunt. So these are the risks that I understand from this situation. Any questions on this?
No, I don't see any question. And my only point over here was, so as I think if that BAT comes online, then actually as an investor you would want HDFC to sell everything, right? That's a good point only. So that's not a risk actually then.
Yeah, if BAT comes online, that is the factor.
If BAT comes online.
Yeah.
So that's a good thing only. So say for example, if both these things happen, as in say in the next 1 month, BAT comes online and the stock goes up. Just hypothetically speaking, things can go completely different way.
Yes.
And then HDFC comes and sells a large chunk of shares. Then naturally the share price will come down. As an investor, you should be at that point of time probably buying it, right? That's a good thing to have happen to you because of one technical reason the stock is going down, where the business prospects have actually improved, right?
I agree with that. So that might be an opportunity when, if and when that happens. So even if before that happens and you feel that BAT comes online, then it might still be a good buying opportunity.
I see Dhruv raising his hand. I'll just unmute him. Yeah, Dhruv, please go ahead.
Hi. So I believe just like all of us, even HDFC is probably waiting for, the BAT to come on board so they can get a higher price and they can exit. And yeah, that is something that is very plausible because they are an institution. They would have, and since it's their company, they would have a better overview of how things are playing out on ground. And yeah, that is a big possibility that they might just exit once that comes on because it's a big chunk that way.
Right.
I think Chitresh has again raised his hand. Shall I take his question?
Yes,
Manan?
please.
Yeah, Chitresh, please go ahead.
But on a contrary, HDFC Securities is giving buy calls in the HOEC and upgrading the target price and all.
Operating the target. Okay.
No,
So
they
yeah,
have,
it's in like one part of the thing wants to sell, so another part it makes sense for them to give a buy call, right?
That's how probably the things work, right?
Yeah, incentives are very high for. See, I'm just drawing a line where there might be no line and they might be operating under Chinese walls, but it's just like I don't give too much weightage to sell side recommendations as such.
Right. So I think Kailash has also raised his hand. Kailash, please go ahead.
Sir, actually, my question is actually on this oil and gas prices, sir. Actually, sir, can you imagine any scenario actually, where things happen in a way, that gas prices, what we are seeing, for the foreseeable future, maybe remaining at elevated levels. So, can there be any scenario, or what would happen actually if I'm the natural gas user? What could happen actually which may bring the gas prices to a much manageable levels, or reasonable level? So can you see any kind of a scenario panning out next 2 to 3 years?
So I didn't understand the question. So scenario relating to if the prices go down, or I don't understand.
Yes, for the gas prices, because the way actually the things stacked up are actually maybe $15 or $16 kind of a prices are being predicted. But what could happen actually which could actually bring the things on the other side of the table? So are there any kind of a
See, even if those things happen, the cost of production for these guys are very low, so they will still be profitable. Obviously, market will not give them the multiple if versus if the gas prices was at 20, gas prices at $6, these guys will still make money, but market might not give them the multiple, so that appreciation might not come in. So in my risk reward scenario, I have assumed, and I'll show that to you, but there is a chance, so we never know what can happen in the future. But yeah, my bet would be, and obviously I am invested in this, so it implies that I feel gas and oil prices should stay high. But even at low prices, because the cost of production for these guys is very low, these guys will still make profit. Even at $1.79, these guys were reporting profit, versus ONGC and Oil India were reporting losses, huge losses, right? So yeah, then obviously your reward from this investment changes drastically if prices go down.
Sir, last thing, sir. Actually, that is from the HOE's, actually stock investments point of view. Actually, if I were to ask you, actually, from a broader perspective, actually from the user and industry side, so and overall global prices side. So, what kind of a things actually, could actually, work it out in a way, actually, so that actually the kind of the pressure that the gas prices is saying, come down, or actually, may prices may come down. So, I'm talking from other yeah.
I understand a lot of things are happening. If these prices stay elevated, there is a lot more incentive for other sorts of energy to come in. For example, the chances of acceleration in renewable production might happen. Lot of things can happen if the prices stay high, because if prices stay low, the incentives for other forms are lower. But if prices stay high, then incentives for other forms of energy might increase. People might start putting in nuclear plants, right? So even for example, Germany has started doing thermal now. So that was an unconceivable scenario 1 year back, even 6-7 months back.
Yes.
So then those kind of things will happen. So yeah.
Yeah, okay, sir. Actually, so as they say, the solution for the high gas prices are the high gas prices, maybe, correct.
Yeah.
Got it. Thanks a lot, sir. Actually,
Sure.
it was really insightful, sir. Thank you.
Sure. So next thing, there no more questions on that, right, Ankit?
Yes, Manan. No more questions. You can go ahead.
Okay, cool. So now, as I mentioned, that I look out for triggers or catalysts which will unlock value at some point. So these are the different types of triggers that I could envisage. So one is industry related, that you suddenly enter a cyclical upturn, or industry changes happen, consolidation happens. Like for example, what happened in steel. Now it's a much more consolidated industry, and it coincided with a cyclical upturn. A lot of players in steel made money. Regulatory regime can change in your favor, so that might also happen. Valuations, obviously there is a big seller, and because of that the valuation is cheap. When that stock of that seller will be over, then the technical factor will go off, so that is another trigger. Special situations unlock the trigger. For example, what is happening in a lot of government companies, that they are demerging their non-core assets and divesting the core assets. So all these situations also play an important part. If you know these situations, and if you feel the valuation is still there, then you can maybe enter that. Management change, I feel, is a very important trigger for a lot of the things. So if there is some change happening somewhere in form of actions of the management or the management itself changing, then it might be a very interesting place to look at. Because, for example, CG Power again, the company was in distress, but a very good management took it over and turned around company in no time. So, and it was public news. Someone could have bought it at those prices where management was buying, or even somewhat higher prices. But you could have gotten a very good return in that sense. It doesn't always play out, but to some extent there should be some change happening somewhere for the value to unlock. Now, simplification of businesses also happen. Corporate structure is simplified. All those things happen. And for example, in B80, that there might be an earnings spike or a step function when B80 comes online. So those things are there. Hidden assets like subsidiary might go for an IPO. Or in this case, there is a subsidiary which can generate 150 crores of PBT. So that's, in my opinion, market is not giving it enough value. So all these triggers, if some of them play out, then we get unlock value for our investment. Now, this in HOEC, these triggers, some triggers have already played out, that management change has happened, cyclical upturn has happened. Everyone knows about B80. Obviously, there is uncertainty around the production. Regulatory regime, when they gave marketing freedom, it improved, but then they imposed windfall tax, so it's sort of somewhere in between. And uh, and uh, and yeah, I think these are largely the triggers in place for HOEC. Higher oil prices might further help, but yeah, these are the triggers in place for HOEC. So next, this is a small history of whatever happened in the first innings before these Ilango and Mr. Jiva took over. There was a bull run during 2002, and when energy prices went up. So when energy prices go up, or when your commodities go up, or in general the prices of your products go up, there is a good chance that your your business performance will improve, and stock price will also resonate with that. But huge things happen when there is excitement around some asset coming online. So this is the thing in PY1. When PY1 in 2009, like there were news that PY1 will come online. Before that, the stock price spiked like anything. But unfortunately, PY1 did not deliver or live up to its promise, and it started faltering. And there was this PY3 asset also, which stopped production, which was a joint venture with some other guys, which stopped production, and the stock price again resonated. So in general, there is a market cycle that is going on, which happened from 2002 to 2008. Then there is a capital cycle, or for the company itself, which happened in 2009, and the stock shot up like anything. So that's the capital cycle. And commodity cycle, market cycle are not generally always in line with the capital cycle. So as I explained, the investments are not happening in oil and gas. So while the markets might face the inflation, and the stock price might have, markets in general face headwinds, there might be tailwinds for the capital cycle players. So I was reading somewhere during 1929, when there was real recession for almost 10 years, the only things that did well were commodities, because their capital cycle was playing in a different way. The commodities actually made money during those 10 years of flat out in US from 29 to 37. Right? So those market cycles and capital cycles play out somewhat differently for these companies. So you have to keep that in mind. Yeah. So learnings, essentially, this is the second part of the innings when Mr. Jiva and Ilango took over. The write-offs happened, and then you got a buying opportunity for 2-3 years till the time D-Rock started producing. So, and you got an opportunity to buy even at a lower price than management at some point. But when D-Rock started producing, the stock price again went up. Within a year, it became almost 3-4x. And then PY1 stopped. So some or the other problem has been coming around. And again, in the COVID crash happened, oil prices collapsed. So all those things coincided. And then you again got a buying opportunity, which was there for you 3 or 4 years back. So this industry is a bit tricky in that sense. It can move very fast, and because of asset concentration, something not working out, the things can go against you or for you in much faster manner. So yeah, and when things are down and out, if you choose to make that bet, it might be much more rewarding. Okay. So this is the one thing that I think of a lot when I take any position. So there is this expected value framework which was there in security analysis, and Professor Bakshi has also talked about it. So if you guys play poker or something, you would understand that there are odds of winning, that is probabilities of winning, and then there are chances, like if you win, how much you can win. So as George Soros said, that it is not important how many times you are right or wrong, but it is important how much money you make when you are right and how much you lose when you are wrong. So while in this case, the odds might or might not be in favor, even the probability of things working out might be less, but if things work out, you make a lot of money. And that is the kind of bets that I like to take. When things align, that probabilities are also good and payouts are also good, that is the time when you take much bigger bets, right? Am I able to convey this framework clearly?
Yes, Manan, very much.
Okay.
Completely agree with you there.
And obviously nothing is precise. You cannot point out that this is the probability or this is the exact amount of payout that I get, but you operate in ranges, and it will always be a game of incomplete information. You will not have complete information at any point in time. So you will have to adjust for that and make scenarios in what all can happen with good amount of probability. Now, I think this is a very common slide and most of you know the valuations. In this case, it is very tricky, but the thumb of rule that I follow for most of my investments is if things work out, then in how many years the profit can be equal to market cap, the cumulative profits. So if this is like 3, 4, 5 years, then it's a very good bet. And if you add high probability to that, then you get a sort of a very good expected value for your bet. So that is the general framework that I use, which I have used in case of HOEC also. And this is largely the risk reward ratio that I am working with at this point. Now, I have assumed, sorry, there are two scenarios that I am thinking about. I'm trying to move my video bar somewhere else. Okay. Now these are the two scenarios. These are not worst and best case scenarios, but let's say in a bad case scenario, if BAT, if oil is at $50, and that will determine the price of gas as well because it's a formula of 22%, then I'm talking about the bad case, then the EBITDA from BAT will be around 140 crores. And these are largely, these are not exact figures. I'm just talking about what all can happen. And obviously currency also comes into play. So if Indian currency depreciates further, HOEC gets benefited because of that. Now, So in case of low energy price scenario at $50 a barrel, BAT will generate a 140 crores of EBITDA. DROC will do at $5 per MMBTU 90 crores EBITDA, and the other assets, which are other fields, can do around 10 crores. Now EBITDA from these products will be around 240 crores. Now EBITDA from subsidiary. Now I'm considering it's largely a flat. It's a flat thing, but just to give you idea of good and bad case, I've changed the EBITDA to some extent, but it should largely remain flat in all the cases. Now in the very base case, it can do an EBITDA of 150 crores, but there is a very high probability that it will keep on doing 200 crores of EBITDA. But let's say EBITDA of 150 crores, then the total enterprise value at for production oil wells, I've taken a multiple of 4, and for subsidiary I've taken a multiple of 6 because the variation is less. So we get a EV of around 1800 1900 crore rupees. Current EV is around 2500 crore rupees. Now the downside will be around 13-14% in my opinion, if bad case plays out, if oil is bad. And I might be completely wrong. This is just to give an idea of the expected value framework. Okay. In the good case, if oil prices stay at $90 and corresponding gas prices for BAT, then BAT does a EBITDA of 340 crores. At $9 per MMBTU, DROC does a 170 crores EBITDA. Other assets do 30 crore. So overall EBITDA from those things would be around 540 crores. If you give a 7 times multiple, because if things are well, the multiple markets generally assign a good multiple. If things are bad, markets assign bad multiple. So multiple can be 7, and this is also a conservative multiple. In the past, it has traded at 20 times multiple also, but I'm taking just 7. So the EV in that case would be around 3,800 crores for the assets. And please remember that I'm not factoring in any optionalities that we talked about. The growth in DROC might be completely separate. BAT extra production can be separate. Other assets can be different thing, and multiple re-rating can be another thing. But in the current scenario, in a good case with a decent probability, the EV of around the assets will be 3,800 crores. Again, subsidiary EBITDA, which would be 200 crores in all the cases, but in a good case, 200 crores and a multiple of 10 gives an EV of 2,000 crores. So overall, we get a EV of 5,700. And if these cases play out in next 3-4 years, company will anyways be debt free, because it has around 350 crores of debt at this point. So 3 years out, my upside in a good case scenario can be 2.5 times plus, and in a bad case scenario, it might not be so bad. But we are not talking about worst case scenarios. Worst case scenarios, BAT doesn't come in, DROC stops production. The things can be very bad, but I'll assign a less probability to that. And best case scenario, you will get lucky if it plays out. The oil prices go through the roof, BAT production increases, DROC growth comes in. Lot of things can happen for good also. So this is the largely, someone asked the question, what can happen in BAT profitability wise. I talked about that. So we can discuss if you have any questions on this. I think largely my presentation is over.
Manan, so very good presentation. I will just keep on repeating what others have said, but just one question is what you have written on the in the text version. You have written that the worst case scenario can be very bad and best case scenario luck if it plays out. So, and in the numbers you have given the bad case and the good case. Any color, maybe ballpark color on the best case and the worst case, where it can be?
So see, worst case, nothing works out at all for the company, right? I will assign a very low probability for that. Like oil price environment also becomes very bad. BAT doesn't produce, DROC doesn't produce, none of the other assets produce. So worst case can be like what? It can be zero, but with a very negligible probability. But I don't think it can be that. If some things BAT doesn't come in, then the worst case might be you might be down 60-70% from the current levels. So that is something if you are able to live with, and you have to calibrate your allocation in that sense. So see, all these are independent events. If oil prices is one probability, BAT production is another probability, DROC is another probability, and all the other assets are another probability. Let's say that there is a 20% chance each of these go bad. So in case of independent events, you multiply all these probabilities and you get a probability of all these things going wrong at the same time to be very low, like 0.20 raised to 4, which will be I don't know, 0.032 or maybe even less percentage. So percentage wise, that probability goes very low. So even if you assign 100% downside to that, then the chances of facing that part becomes negligible almost. Right? I'm taking 100% downside, which rarely happens. So, but the probability of that is very low. So that is the worst case scenario. Now the best case scenario is oil prices are very high. BAT comes on and stabilizes production, increases the production. Then you don't know like what all can happen, right? It's very difficult to assign. So I don't assign probabilities to that. But again, if we assign very low probabilities to the best case scenarios, the payout can be phenomenal. And because that payout can be so high, your weightage of the best case scenario goes up. Right? The probability multiplied by odds multiplied by payout. So there can be a case where HOEC can be a 10,000 crore company, even if the probability is, let's say, 5%. And if you add it to the expected value equation, you get a good weightage for that. So that is how I look at it. And you never envisage. So just like you cannot say that I have bought a 100 bagger. It plays out over a period of time. You just say that next 2-3 years, these are the likely scenarios and they can play out. If things work out well, I can make such and such money. But if things go much better than expected, then you ride on to that, and then those things become multi-bagger at some point in time. So you never buy a multi-bagger right from the start. So if I say I'm buying like 10x right from the start, then I'll be fooling myself. But I buy the companies where I see at least 2 or 3x the upside within next 3 or 4 years if things work out well on a risk reward adjusted basis. So those are the kinds of bet that I like to take. And if the probability is higher, then my allocation will also be higher. So that is how I think about it.
Thanks, Manan. That really helped. So I see 3 hands being raised. I'll just start with Krunal. Krunal, you can go ahead.
Thank you so much, sir, for giving such a level of clarity. I just have like, since you have made EBITDA calculations, you have made certain assumptions. The first assumption you have is of the price of US dollars, right? Are there any assumptions you made other than this?
Yeah, so there are multiple assumptions in the level of BAT production. So in the bad case, I have taken a lower amount of production. Then I have assumed like 75 rupee INR conversion of 75. Oil price assumption is there. So there are multiple assumptions that go into this. DROC $5, like APM price will be $5. That is another assumption. DROC production.
Other than price, like volume
So
assumption.
volume also in the bad case scenario, I have assumed less volume from BAT. Like management is saying 7,500 barrel oil equivalent. I have taken around 5,000-6,000.
Mhm.
Right? All those assumptions are there.
In this good case scenario, what is the volume that you have taken for BAT gas production?
Around 7,500. Gas production you are talking, gas production is at around 10 or 12 MMSCFD.
Okay, okay. And the second question is, you have also taken into consideration the royalty and the other revenue sharing deductions, right? Before coming to this EBITDA?
Of course. So all the revenue sharing and royalty is out of this.
Okay. Because like when in the best case, good case scenario, when the revenue will go up, the royalty payments would also.
I have factored in the same formula that
Okay.
management has. So as the production or daily revenue goes up, their revenue sharing increases. So I've replicated the exact formula there.
Okay. Yeah, that helps a lot. Thank you so much, sir.
Sure. Any other questions?
Yeah, there are two. I think Chitresh has raised his hand. I'll unmute Chitresh. Chitresh, you can go ahead.
Yeah, hi, man. So just wanted to know one thing, man. Like, I have actually three questions. So first was regarding, if you're so bullish in the gas prices and the oil prices. So the recent thing which happened in Ceylon, the new management taking over, I'm sure you're aware of that, and also those drilling companies like Jindal and others. So what are your takes on them when compared to HOEC?
To be honest, Ceylon, I'm still trying to understand. I'm working on it. That is also an interesting situation. But if you would have gone through annual reports, there is absolutely no data at all. So we don't know what the levels of production are. We don't know what the reserves they have. They have given historic data, but I'll wait for the new data to come in and absorb that, because Ceylon is again oil plus gas. And Ceylon is concentrated largely in one asset that produces most bulk of the things. So it might be a very interesting situation, but I'll wait for some more clarity before I do some work on that. I have done some work, but I'll wait for more clarity. In Jindal drilling, see, I have not worked on those vendors much, so won't be able to comment. Sorry for that. Because if I'm bullish on oil, I'll rather play directly through oil rather than through vendors. Obviously, the risk in those vendors might be lesser compared to the direct plays. So it's like if you are bullish on steel, you can play steel directly, or you can play steel through refractories and all those things, right? But in this case, I think HOEC provides a very good risk reward ratio for me to think about the other service providers.
Sure, Manan. And second thing was regarding the gas APM prices. So it was in April they fixed it as $6. So after that, I think the gas prices have increased a bit overall everywhere. So anything you expect in October?
Yeah, see, I think if the formula, they stick to that formula, it should be more than $10. But as you know, government can come and change because it's a politically sensitive issue also. So I don't know, but it should, according to formula, it should be more than $10.
But as in the con call and others, management has highlighted that their production, they're not able to sell enough at current prices itself. The production level have actually gone down because there's less offtake by the players who uses this gas. So
Yeah.
players are not buying gas. They're not able to digest these high prices. So what do you
See,
think about that?
at some point they will have to digest it, but to be cautious, I have taken production of DROC at 25, even in the good case, 25 MMSCFD. Their production capacity, they have done 40 also at some points. But if those plants have to produce, let's say Brahmaputra cracker and all those people have to produce, and if they start, they can buy oil from gas from Oil India also. But at some point, Oil India will also be selling at $10 at APM prices, and that is largely disconnected from the market prices. So if they have to operate, they will have to buy oil. So I don't think the production can go below 25. If that goes, then we have to rethink about those assumptions. But I have taken 25 only, 25 MMSCFD of production versus the capacity is more than almost 40 MMSCFD.
Yeah, because the APM prices plus $1 is also not applicable quite completely on the whole DROC. I think they are doing only 30 to 40% of the sales in the plus one APM, right? So that plus one is the reason you think the offtake is less, or
No, see, offtake has been less because people have been, if you look at the gas prices for last many years, they have been sub $4. So it might take time for them to absorb. They have been protected from volatility because of this APM prices. So the volume offtake, one thing was they planned a shutdown or something in the last quarter. That was one reason the production, the offtake even went lower. But if they are not viable at current energy prices, then they will have to stop production, or else government might come in and say that Oil India will sell at $5, even though the price is APM is $10. If something like that can always happen. So we don't know about those things. That $1, see, $1 is a pocket change if the prices become $10, right? So they can choose to sell through Oil India at $10 and they can be okay. We don't want premium on anything, but $10 will be very good for DROC at APM. And $1 will be pocket change at those levels, hardly 10% more, right?
so as you're following this industry more, this is my last question. Just wanted to check, regarding B80, as they were already producing the gas from the D2 field for 1.5 months, and as per the con call, they have told the issue is not that big and would be solvable in 1 or 2 days. They are just waiting for the monsoon to get over, because I don't know the technical details of the problem. And if you are aware, do you think the management is really guiding us well there? I mean, the problem is really very small by the nature of or the name of the problem. I mean, because I'm not aware of those technical terms.
See, even I am not aware of that fact, but to some extent, you have to trust the management when you talk about these things. Another thing is, if you feel that they are over promising, then you factor in your assumptions that the production will come in 6 months late, and based on that you take your call accordingly, right? You do your projections or whatever accordingly. So, or either you wait for that complete clarity to emerge. Even I don't have clarity whether manage, because they have been proven wrong so many times, and to be sympathetic to them, even they might not know what issues might crop up, because this is a very different ball game. So I don't know if it comes on production well and good, but I would expect there is something called Hofstadter's law. One of my good investor friends told me about it, that things will get delayed even if you factor in this law. So if you think about it, most of the things that I want to retire at 35 or 40, but things will get delayed. My salary hikes will get delayed. Most of the things that we want things to happen very fast, but if you assume that everything will get delayed, then you take your calls accordingly. That is what I would say here, because I don't know what can happen. Uske baad some other issues might come up, we don't know, right? So, and this will always be a game of incomplete information.
मैंने तो अपना इन्वेस्टमेंट उस हिसाब से किया था HOC में, बिकॉज आफ्टर गेटिंग द डिटेल कि हाँ भाई oil produce होने लग गया है, and GSP and they're able to sell GSPL at this particular dollars. I mean, no, 22%, and prices were good. But now, when things turn, I mean, it becomes really difficult to stay invested, or how we should plan for it, book loss, and get that money somewhere else.
Yeah, so see, the one rule of thumb is that you just you determine that let's say if you have invested 5% of the capital in the company of your portfolio, and how much amount of mental capital you are spending on that. So if you are 5% invested, but you are like uh, 5 out of 10, 16 waking hours you are thinking of HOEC, then you are spending a lot more mental capital versus the commensurate position sizing. So you bring down your position sizing accordingly so that your mental capital gets used accordingly. Or if you want to sell out and sleep well, that is also fine. You wait for the certainty to come in. So those are the things that I'll think about. You try selling and sitting on it and think about it. Then you will be mentally free. It has happened with me in the past. So from experience, I'm saying.
Sure, sure. Thanks, Manan. And anything on PY1, Manan? Like, I mean, they have recently got the 10-year extension. Like how that is going to plan out.
See, I have not factored that in my assumption. So if that comes in, that is a bonus. But I don't know how much capital they will spend on, or how much ability or technical capabilities they have to bring that well to production. I don't know that, and I have not factored that in my assumption. So if it comes in, it will be bonus. But I, to some extent, also think that their contracted price is $3.6 per MMBTU. So it's better that they don't spend capital on that if they have to sell at $3.6 in the current energy environment. So, but the idea is they have all the infrastructure in place, and that is the only well they own 100% of. So entire thing will flow to them. They have complete control over the operations there.
And
But
still,
yeah,
they will be making 4 times money. I mean, the cost of production would be 0.8, 0.9.
yeah, so they will be making money, but they should keep those assets for like they can revise the prices upward somehow, or they should keep those assets whenever they should focus on something else when they can get better bang for their buck.
Sure, thanks, Manan. This is really interesting, and very happy to attend this session. Thank you.
Sure, thank you.
Thank you, Chitresh, for some really good question. And Manan, I really like the way you answered that of getting out of the stock, freeing your mind. So these are things which I feel it is easier to say. And once, so like you have already experienced that, so you must value, you might be able to value that experience much more than anyone who is just listening to it or maybe just saying about it. Right.
Right.
So,
Hey, एक बार loss book कर दिया, then your mind becomes much freer. Initially, you are afraid of booking a loss, but once you do
right.
that, your mind completely frees up, and you are sort of you can think afresh. So that is what my
Right.
experience has been.
So I see 4 hands being raised. I hope you have time, Manan, because
Yeah,
it's already three
we can
hours.
go on.
Okay, great. So, Dr. MP Bajaj, I have again unmuted you. You can go ahead with your question.
Can you please come to your valuation slide again?
I think these are the two slides on valuation
Yes.
that I have.
I'm still struggling with valuation metrics.
Hmm.
I'm invested since last 30 years, but understanding right now only. So DCF method I have done, and I found lot of assumptions are there.
Correct.
And unless you know very details like you did in HOEC, I don't find much valuation here. But most of you people do it, DCF valuation, to find out the EV values. So where are the things where these replacement costs, apart from cyclicals like cement, metals, all these things, this should work better for me. If I don't believe on DCF, then what are the other valuation things I should see?
So it's a very broad question actually. So any form of valuation should have a sort of DCF, even though you don't make a Excel, and I don't make a DCF on Excel or anything. So largely any valuation is saying, or any valuation of company is as good as the cash flows it will generate in the future. If I am not going to generate any cash flows from that asset, my replacement cost counts for nothing. right? If there is a hotel sitting out there, but it is not operational, even though it might be on the prime land, for a shareholder, it might not amount to anything until unless someone decides to buy it and bring it to operations. So all the forms of PE multiple, if you look at EV to EBITDA, if you look at, all are sort of thumb rules for DCF in some way. For example, EV by EBITDA is a valuation which says that you will earn your EV in X number of years if this is the EBITDA. So if 100 is the EBITDA and 20 is the EV by EBITDA ratio, then you are saying you will have like 20 years in which you will earn 100 or maybe 25, because if you factor in time value of money, so you will earn your EV in these many number of years. So that is the ultimate thing. Everything else is a thumb rule or derivative of that, right? So that is how I think about it. If my company is going to generate enough profits to pay itself off in next 5 to 7 years, if the answer is yes, then it might be an interesting situation for me. If not, so I am not invested in any of these high multiple companies. Like let's say there are some companies trading at 100 times P by E. There is a huge factor that says like there will be X amount of growth that will come in, then I can justify my valuation. Even though the business might be great, but it might not be a great investment from my perspective, because I don't have a visibility of 100 years or 20 years or even 10 years. I have visibility of, in this case, HOEC, for example, I have visibility of, let's say, 2 or 3 or 5 years. But if HOEC, BAT and all things come out, the market cap will be earned in 5 to 6 years at the most. So then everything else after that is free for me. So that is how I think about it. So replacement, it depends on the industry. Replacement cost is just a placeholder because the industries are too cyclical and we cannot predict profitability, and everything is cyclical. Margins are cyclical, sales are cyclical. So because we cannot do that, we say that we will use a replacement cost. If someone wants to set up this asset, it will take this much amount of money, but that only if that company is operational. So for HOEC, there might not be any replacement cost. I might not be able to figure out, because ONGC might put the same asset at much higher price than what HOEC did in DROC, right? So that's how their like sort of competitive advantage is also there. I'm not sure if I'm able to answer that, but all forms of valuations are some of the future cash flows and derivatives of that.
Thank you, Manan. I really understood the DCF first time. कि you put a figure कि अगर कैश फ्लो से 5 साल में आपका मार्केट कैप निकल जाता है, तो that is a good value. Am I correct? You want to convey that?
Yes.
Thank you
So that is the understanding.
Yes, thank you very much.
Thank you so much, Dr. Bajaj. Let me just, Chaitanya, I'm unmuting you. You can go ahead and ask your question.
Thank you for the presentation, sir. So just one question, sir. It was in regard to the Duroc field. So like they're constructing two gas lines. Like one is being constructed by HOEC itself, and one is that Indradhanush pipeline. So like, can you tell the implications of both of them, sir?
So the idea is market right now in DROC is very small, so they can sell to very limited number of customers. And DROC is using Oil India's pipeline to sell their gas. Now, when they put in their own pipeline and connect to a junction, they will be using their own pipeline and will get connected to many more number of customers. So that is the idea. And like Indradhanush and all those comes in, that connects, like if lot many regions are connected into the same grid, so the gas produced in DROC can be sold to someone in UP or let's say in Gujarat also, if the grid is connected, right now they are operating in sort of isolated, that the tea gardens there will buy their gas, or the small other things, other people will buy their gas. So that is a limitation that they have right now. Once they connect through their own pipeline to a Duliajan junction, and they have access to more number of customers. And once other assets come into play, like more number of pipes are connected to that grid, so it's like a network effect. So if there are only two pipes, there are limited numbers, but if there are 10 pipes, then the options multiply. They don't increase linearly, right? So they exponentially increase. So that's a sort of network effect kicks in when the entire thing is connected by a grid. So that is the implication, that ability to market to many customers and increase the volumes will go up.
Okay. Thank you, sir. So just one more question. So like they have a long-term contract with GSPC, I think, of like they'll be selling the gas from BAT at 22% of the Brent of the previous month, right? So,
Yes.
sir, like how like is there a limit to the volume of it, or like after a particular volume they can sell it at a higher price or a lower price as they want?
So they have committed volumes of 10 MMSCFD, and they say their production can be around 12 MMSCFD. So
I think they also
it
said that it can be extended up to 15 mmSCD also, right?
15 MMSCFD is the capacity, but for using their own production, they will need some energy. So they will use the remaining for that. But the Gujarat market is such a big market that GSPC can absorb that gas. Anyways, they will be buying from the open market, spot market, which is at much higher valuation. So, so you can say that it won't be a problem for GSPC to buy that gas. If GSPC doesn't buy, someone else will buy, because spot market, and they can sell in spot market HOEC.
So that's what I was asking, because like the long-term contract is at 22% of Brent. So that's
It is
like
just 2
as
years contract.
yeah.
So that will get revised later on.
So as of now, I think the spot is also trading at $35 and $40 MMBTU. So after
Yes.
after 10 MMCAD, can they sell it at a higher price right now, like in these 2 years?
Yeah, we will have to wait. First, let's 10 to come in. So,
Okay.
so if 10 comes in, you are sorted. Other things are all optionalities that can play out and that can turn into a best case scenario. But for our investment at this point, we want first those 10 to be regular, right?
Okay. Thank
So
you so much,
then,
sir.
yeah, sure.
Thank you, Chaitanya, for your question. So I had a lot of questions written down for asking you for your process and all, but I don't think we have time for that today. So because I still see two hands being raised. So
Sure.
Kunal, you can go ahead. I've unmuted you.
Okay. Yeah, thank you, sir. Just to give my perspective on the kind of contract they have with GSPC as of now. For first year, it is not supply or pay, and for second year, it is supply and pay. So my interpretation for that is like they would not be able to afford if they do not start it as soon as possible, because in second year, if they do not supply that gas, they will have to pay that money, equivalent money for that.
Yes, that is true.
Right? So the possibility is very high that they will make things work pretty fast because they would not want to end up paying the money, so that because they have made such an agreement with them.
Right. No, so that's a standard format of agreement across the contracts.
Yeah.
So and there are limits to which you have to pay if you don't supply. ऐसा नहीं है कि you will have to pay for entire production if you are not able to supply. So there are caps in which GSPC also enjoys that limit and HOEC also enjoys that limit. Till if you don't supply, you will have to give your penalties up to that cap. So it's not that HOEC will have to pay substantial amount from their pockets, or GSPC if they don't offtake. So there are some things built in. That is the standard contract format that I understand. From
It's 80%, right? 80% take or pay. Yeah, supply or pay
but
on
yeah,
their
it
end.
might be 80% take or pay. But if I don't supply zero, it doesn't mean that I have to pay for that entire 80%. That is what my understanding is. I can be wrong, but as you say, they will have to make it work out, right?
Yeah,
Otherwise, it's a problem. And if it doesn't work out, anyways, the bets are off for
yeah.
us.
So if it works out and the possibility is looking at that kind of contract, the possibility is very high they will make things work out pretty fast. Otherwise, they would not have done such a kind of contract.
Let's hope so, but that's a standard contract, Kunal. It's not
No,
specific to this one.
otherwise, see, if they do not see the volume consistency for foreseeable future, they would sell it on exchange, right? They would not make a long-term contract. That is what my interpretation is.
Yeah, that's true, but obviously they are optimistic people, right? As we understood that they have
Yeah.
been over promising. They are optimistic people, so they can go wrong on this as well.
Okay, got it. Yeah, that helps a lot. Thank you.
Yep.
So, Manan, I think now only one hand is being raised. This is for Mr. Kailash.
Sure.
Kailash, please go ahead and ask your question.
Yes, sir. Actually, my question is, sir, actually, as everybody knows, the Charlie Munger actually is the only person in US actually who is opposed, for any export. He's even opposing the production of the oil and gas from the US soil. What his opinion is, we need to got to put it actually under the earth. We don't need to got to produce it. Let the Arabs, let the whole world actually produce every drop of oil, and we have to preserve it. So because of its usage, not in in normal life, but actually in agri-chemicals, whereas feeding the 8.5 or 9 billion people of the earth. So he's of the firm opinion that these are the most precious, the things, he regards them as. And recent Buffett's, buyout of the Occidental, and he may be actually buy it out actually completely. So, sir, one thing, if I have to come to the conclusion that on price front, it's pretty clear those are going to be remain in a very sweet spot for the HOEC. It's just that actually if they can manage, to get the things on stream and with a bit of a stroke of luck and their efficiency actually may can actually attract actually more actually marginal fields from the oil Indias and the ONGCs of the world. So is this the net conclusion actually that I'm right actually that the long term price trend is quite clear, looking at the importance, the strategic importance that Mr. Munger gives. He is even opposing produce even a single drop even at these prices.
So yeah, so see, Mr. Munger has his own views and he is very eccentric, and most of the times he has been proven right. But yeah, for us to, we have to be cognizant of the facts that we have that probability in mind that the prices will stay high, but there can be alternate scenarios where price might not be so high. So we have to be cognizant of that fact, and at the end of the day, we have to make money, right? That's the bottom line. So if things are not working out, we have to be we have to be nimble enough to recognize that and get out of the position if things are not working out. So and it's very difficult to take this kind of a call saying that prices will remain high. They should remain high from what we understand at this point, but there might be some other data points few years down the line or few quarters down the line that we understand there might be some very big discovery somewhere else, and that might bring down the oil prices globally, right? We don't know. So I think we have to be nimble enough to accept that we can change our view whenever the facts change. So yeah, I agree at this point. I also feel that oil prices and gas prices should remain high, but things can change very fast in this industry. So we have to be nimble enough for that also.
So, sir, could Iran and Venezuela may come into the mainstream actually when it comes to, because it's a situation actually that brings all the on the same platform. So could Iran and Venezuela can actually come into the forefront of this scheme of things?
Sir, in this is a huge geopolitical issue, and I am too small a guy to figure that out.
Okay, no, sir. Actually, it's a really wonderful, sir. Actually, as Mangar also says, actually, the ultimate goal of the life is to help others. Thank you very much, actually, for helping us to understand this the most complicated issue. Really, really appreciate, sir.
I'm happy that you found it useful.
Yes, absolutely.
Thank you so much, Kailash, for asking that last question. And before we end, Manan, I first have to share with you a few of the comments. So Dr. Bajaj says that great lessons by Manan, requesting him to write a detailed blog on valuations. So I hope you start writing again. I have read your blogs, but I think you have stopped writing after as in, you have not been posting anything on your blog recently. So maybe this comment can motivate you to start writing again, and we will definitely be all a keen reader and learner of your blogs. So
Sure, I'll definitely consider that.
yeah, and I will still think that there were so many questions I had in my mind which I wanted to ask you, but it's good that we had audience who found so much of value in what you were presenting. So it's good that we had a very, very, very interacting discussion. And I just have one request to all of you, that if you are on Twitter, please tag Manan and SmartSync Services and spread the word so that we get more like-minded investors like you attending our sessions. And that is the whole purpose of this thing. SmartSync Services do not have any holding or any coverage on the stock. We have no vested interest. Our only interest is to keep reaching out to great investors like Manan and keep sharing it to a larger audience so that we all can benefit out of it. Manan, your last few words before we wrap up today's session.
So yeah, thank you for this opportunity again, and I must congratulate very educated audience we had. So it was a very good discussion. So thank you everyone for doing great work on this. And I also got to learn and collate my thoughts because of this presentation. So it's a good opportunity it was a good opportunity for me also. And everyone can obviously feel free to reach out to me. Ankit has my coordinates, and we can discuss anytime. And another thing I wanted to say, so keep investing. uh, Small and mid caps are really the place to be these days, and I think for little bit of additional risk that we perceive we take in small and mid cap companies, the returns can be outsized compared to what you can make in large caps, because there is very little value that we can add to huge analyst community that are tracking large caps. Small caps, undiscovered place like this, give very good risk reward ratio over a period of time. And if you have enough number of these kind of bets, you can make a good amount of money at some point going down the line. And so great job, Ankit, you are doing. Everyone, thanks a lot for participating and doing very good work on this. So thank you.
Thank you so much, everyone. And thank you, Manan, once again for this insightful session. And as always, we'll share the recording and the key lessons very soon, probably sometime in the next week. Thank you so much, Manan. And thank you so much, everyone.
Thank you, everyone. Bye.